consumers are dipping into their savings, and that's what's sustaining the health of consumption in the US.
The consumer is really the most important data point here.
The Fed's not going to come to the rescue. There's no V-shaped recovery here.
The market has tightened a lot for them already, and they've only done one small 25 basis point rate hike and a 50.
I think the Fed is going to have to decide between two policy mistakes.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures down about 0.7%. TK, a hot one in New York City.
It is a hot one in New York City, and it is about utilities. And John, to me, it's just as much about utilities in Europe as well. What are those utility bills going to be given that inflation?
TK, that inflation data out of Germany yesterday, upside surprise. Spain, Italy, France, take your pick. For Europe, 8.1%, your headline number in the Eurozone, TK. Big meeting for the ECB next week.
A huge meeting for the ECB, and, obviously they've got to do something about this. And, over the weekend in the zeitgeist, and I think this was missed, John, very much, is Lagarde had some real strident language about enough. She had a blog out, and she basically said, enough, let's go.
Governor Waller said the same thing, Tom. Enough of the happy talk after we heard from President Bostic last week. Here's the quote, Lisa. I'm not taking 50 basis point hikes off the table until I see inflation coming down closer to our 2% target. That's the reality check from the Fed governor.
And all of a sudden, the narrative of last week, which was suddenly that perhaps the Fed isn't going to go as far or as fast as many people thought, just gets thrown out the window, right? People saying, well, maybe they do mean it. Maybe they do intend on continuing to go with even 50 basis point hikes until they get something under control as we get increasingly high inflation prints over in Europe, probably translating to something sustainable back here.
Bramo, last week was quite a week. Big week again.
Oh, was it, John? Tell us about Capri.
We can talk about that later,
quite a
TK.
week? Okay.
It wasn't Capri. It was walking through the countryside of the United Kingdom.
It's good to have you back, John.
At ease.
Yes.
Zen, as I always am. But more zen this time around.
No, last week was a big week because you did see a bit of a reprieve from 7 straight weeks of losses. All of a sudden, you see gains. How do we frame those gains going out? Are they simply a pause? Are they a bear market rally? Or are they something different, as you were talking about earlier, John?
I'm pretty sure TK's got more stories about last week than I have.
John, Velveeta fondue. That's my new recipe.
Is that right?
Tried to make it up. Vet Bill would need it.
Out?
Let me show you what this meeting's about today, John. I mean, the language here is hilarious. Here's the math. And this is just a recent article. Wage growth, 5.6%. Pretty snappy. John, inflation, 8.5%. I think that's negative wage growth. You think that has a little bit to do with this meeting today?
The Fed chair sitting down with Secretary Yellen, Lisa sitting down with Chairman Powell. What are we looking for from this going into payrolls on Friday?
I think just how unusual this is. This is the first meeting that Jay Powell has had with President Biden since November. Is this basically Jay Powell being given marching orders to go out there and to actually tackle inflation more aggressively? And how much does this compromise the independence of a Fed that already has been seen as very political? I think that's really the tone here after a Memorial Day weekend when everybody was sort of shocked by the prices they were paying.
Driving season. It starts, TK, at what, $4.60 a gallon on average, and in some places much higher.
We're getting near $6 in some basic stuff. John, this language, I want to know if you'd ever see this language in the United Kingdom coming off the Prime Minister's desk. This was off the Treasury Secretary's desk this morning about the meeting that they're going to talk about. And the language of this is just really, really basic. I mean, this is American politics as it go. As we transition from an historic economic recovery to stable, steady growth that works for working families. How's that working, John?
It's not working out, Tom, and that's the problem for this White House. They are owning that CPI print every single month, TK. There's a hope in this market we might have seen that mechanical peak year over year. There's a fear in that White House, Lisa, that we haven't seen the worst of this just yet when it comes to confidence, consumers, and potentially the downdraft we're set to see in growth.
Yeah, and frankly, just based on how quickly it's rolling over, which is not, that's problematic. Even if it goes with a mechanical peak, if it doesn't come down materially, as most people don't expect it to, inflation is going to present a real problem at the midterms.
Should we get a market check?
Please.
Just squeeze one in. Futures negative 28 on the S&P. We're down about 0.7%, just about. Did you do the Dow a lot last week? I imagine you did.
We did
every day.
I bet you did. Yield time by 8 basis points on a 10-year.
7 out of 8 people in Happy Valley.
A lot of that down to Governor Waller. Your 10-year 281.88, and this quiet rally in crude, it continues, Lisa. look at this, up 3.5% at 119 on WTI.
Yeah, and frankly, over in Europe, a much bigger gain as we see touching the highest levels that we've seen, not on an intraday level, but really on a closing level going back to 2012 on Brent. Today, what I'm looking at, 9 a.m., we get a slew of housing data, including FHFA House Price Index and S&P CoreLogic 20 city housing data, which has been at the highest levels on record. Do we see a deceleration in the pace of price increases of homes, given the fact that mortgage rates are really crimping the volumes of sales? This is really a conundrum. If it's not bringing prices down, that we're seeing less dynamism in the market, what can the Fed actually do by raising rates all the more? Or do they have to just go that much more aggressively? 10 a.m., John, you were talking about how people are feeling. We get the Conference Board U.S. consumer confidence data. It has been trending lower, although I do find it interesting to see that there was a surprise to the upside yesterday, or I should say Friday, it feels like yesterday, on the University of Michigan sentiment survey. Economic surprises have been actually trending to the downside of the United States. How much does this indicate, frankly, a slowdown versus just people feeling bad about how quickly inflation is taking off? And at 1:15 p.m., we've been talking about this all morning. U.S. President Biden is meeting with Fed Chair Jerome Powell, as well as Secretary Treasury Janet Yellen, in the Oval Office to talk about how to make a more sustainable recovery. What were the words, Tom? For a working America. And how much can they really talk about the negativity of this when the unemployment rate is near historic lows, when you have wage increases? How do they then dovetail what their plan is when they don't have a lot of control, John, over anything right now when it comes to oil prices or when it comes to supply chain disruptions?
Bramo, thank you. Looking forward to that a little bit later this afternoon. Joining us now is Chris Marangi, the co-chief investment officer at Gabelli Funds. Chris, let's start here. The difference between a bear market rally and something more sustainable. How do you identify the difference between the two?
Well, a bear market rally means that we haven't ultimately hit the bottom for the market, but they're not necessarily all that ephemeral. They can be actually quite lasting and quite powerful. You know, if you look back to the period of the 2000 bear market, I'm not comparing this period necessarily to that one, but you had 6 bear market rallies. 3 of them were over 20%. And that's what makes them so painful for people who are not or don't remain invested.
Chris, I want to talk Gabelli 101, right back to Marangi and Gabelli and all that you've done, and that is the quality of free cash flow. Has the quality of free cash flow been disrupted?
Well, the quality of earnings perhaps has been over this latest bull market, but cash is cash, and that's why we look at that metric primarily, because you can't fake it. Cash flow has been constrained a bit by working capital in particular of late. And that's why we're paying attention to things like LIFO and FIFO, again, concepts that people in decades haven't looked at. But with inflation, it matters.
Chris, I saw you trying to recover from Tom's exclamation about FIFO and LIFO. I do want to get your sense of the margin pressures that we've seen and how that means, what that means in terms of what kind of momentum in earnings we can expect going forward.
Yeah, so the story, we just came through earnings season for the first quarter, obviously. The story has been pretty much the same over the last year. Consumer is strong. Sales are being constrained by an inability to deliver products and services to the consumer because of shortage of goods or labor. And margins have held up reasonably well. But we are really seeing more and more pressure on margins. We saw it just, for example, in the food companies, amongst others, this last quarter. And it's getting, but companies are still able to pass costs through. But again, as we reach higher and higher price levels, that becomes more difficult.
Chris, what have we learned from some of the single-day price action on single names? Some single-name stories over the past few weeks, anywhere from Target to Netflix a few months ago, where you have these big misses, sometimes small misses that generate 10, 20, 25% moves on a single name. Chris, what have you learned from that?
We learned that you got to do the work. I mean, this is some of those misses and some of those stock reactions were companies that didn't have very much valuation support. They were highly speculative, but they were obviously, you mentioned Target and some of the retailers, real companies with real cash flow and real followings. So it's been surprising. It's, basically you've got to buckle up and be ready for the opportunities when they present themselves.
Great to catch up, Chris. As always, Chris Marangi there of Gabelli Funds. Bramo, it's been difficult. Investors, the C-suite, corporate leadership, caught offside by a cycle that is moving so quickly over the last 18 months.
Yeah, but to your point, people were expecting margin compression. People were expecting sales to start to decline, or actually not sales, but just in terms of earnings. How much did they really see a surprise, and how much is it just sort of a reality check after a really frothy period? Just to put this into perspective, how much more can we expect given the fact that quantitative tightening, we've talked a lot about it, it starts Wednesday. It hasn't even started yet, John.
Have we fully seen the earnings reset? Never mind the QT, the rate hikes from the Federal Reserve. Have we fully realised that earnings reset, Lisa, that many people expected coming into this year?
Mike Wilson says no. Mike Wilson says that this is a bear market rally and that we have not yet seen the full reset. Other people agree with him, and then there's still others who are starting to see something more like a buy the dip moment, even if there is more downside over the next 12 months. So how do you sort of look at a time frame given how quickly the market is moving and the economy as well?
I'll catch up with Stavridis Subramaniam of Bank of America a little bit later this morning. She put out a list of questions she's being asked by clients, Tom. Here's one of them. When can I start buying tech? And she turned around, Tom, and said, when clients stop asking us that question, they still receive that question, Tom, all the time.
But I'm going to parse between profit and free cash flow driven tech and everything else. And the everything else has been pounded.
Well, Tom, something you've said just about corporate leadership adjusting. For the previous year, that was about raising prices. And, Tom, you've been looking for the cost cuts. Has that started yet? Is this just the beginning?
I'm getting whispers. I'm getting whispers. There's no question about it. Can I just say, John, in this first section with the three of us back, we've yet to talk about China. I think the gauze here of Shanghai relief and the calendar moving into the summer before the party Congress meetings is underplayed this morning.
It is a factor in the commodity market. Can I ask one question of both of you? First of all, what I saw was absolutely fantastic in Davos. Great job. I know how much work goes into that event for the whole team. Did anyone really talk about the fact that in the last 2 years, China is still being ignored to this extent, Tom? They still can't get in the country and find out what happened with the pandemic and the start of it.
This was somebody, who was it? Someone said when you peel back the onion of Davos, on the outside it's Ukraine, and on the inside it's China.
Folks,
it's all
this is why you watch and listen. Kishore Mahbubani was lights out, the giant of academic Singapore. And John, he teared up when he realized you weren't there.
I bet he did.
A lot
I bet he did. Peter Oppenheimer's happy I'm back. He's going to be joining us from Goldman at 7 a.m. Eastern Time. Futures down about 0.7 to 1%. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. European Union leaders have paved the way for a sixth package of sanctions to punish Russia and President Vladimir Putin. They agreed to pursue a partial ban on Russian oil. It would forbid the purchase of crude and oil and petroleum products from Russia delivered by sea, but there would be a temporary exemption for pipeline crude that would satisfy Hungary, which gets Russian oil via pipeline. President Biden will hold a rare Oval Office meeting today with Federal Reserve Chair Jerome Powell. Treasury Secretary Janet Yellen will join them to discuss what the administration calls the president's top economic priority, inflation. Rising prices are hurting the president with voters just months before midterm elections. And for the first time since early March, the number of daily coronavirus cases in China has dropped below 100. Still, Omicron's contagiousness means the reprieve from infections and the tough COVID-0 response may only be temporary. Both Beijing and Shanghai have started to loosen restrictions on mobility. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Council should now be able to finalize a ban on almost 90% of all Russian oil imports by the end of the year. This is an important step forward. The remaining 10% on these one, we will soon return to the issue.
A plan for a ban. Ursula von der Leyen, their European Commission president, doing what the Europeans do. They wait and they wait and they wait, Tom. Crude up 3.2% on WTI 118. Big move on Brent 123. 181 through 120 in the last 24 hours again, and up by 1.76% this morning. WTI up by more than 3%. Outside of that, yields higher by 8 basis points to 81.88 on a 10-year. You can thank Governor Waller for some of that. Equity futures down about 6 or 7/10 of 1%. On the S&P, TK, we're down about 27 points.
Yeah, well, we're down, and, it's a churn here right now, but I got to admit, John, with the stunning VIX at 25 level, coming back to 27.82 shows maybe a little bit of attention after the great celebration. What a day for the president. He's going to meet with the lads from Korea this afternoon, and, of course, he can look at the song Butter with Jungkook, Jimin, and V, and go sidestep, right, left to my beat.
You need to translate right now.
He's talking about BTS.
I'm aware.
BTS.
K-pop.
But before BTS, he's going to meet with the other lads, the lads from the Inflation Watch. Joe Matthew joins us here in Washington on Yellen and Powell and Biden.
Is she a lad?
Joe, help us here, please. What are they going to talk about?
Well, I can't imagine what's on the agenda today. I'm getting a real kick out of the attention this meeting is generating here because, Tom, I'm pretty sure it's not for you. I don't think it's for Jonathan or Lisa either. And the point here is we're not going to be talking about 50 versus 75 basis points. We're coming off a long holiday weekend.
Right.
We're also coming off a week that we were obsessing over Uvalde. We were talking about everything except economic issues that this president needs to get his arms around. And I would say look no further than the front page of the Washington Post this morning. I don't know if you saw this story, but this is what normal people are reading. U.S. policymakers misjudged inflation threat until it was too late, complete with a timeline that goes back to February 21. This is not a news conference. This is not a briefing. They're going to be in the Oval. This is about optics. They're going to let the pool reporters come in. They'll ask a couple of questions. You'll see images of the three of them on the couches. And I'm sure the question shouted at the president here, maybe Jay Powell, is going to be, has inflation peaked? These are broad brushstrokes for people at home who are starting to tune into this.
But yeah, to tune into BTS and their great song Butter, sidestep right, left to my beat. What he's going to hear from Chairman Powell is it's my beat. Powell's in charge, right?
Yes. Yes, and Joe Biden will say that. I can only imagine because of concerns about, well, wait a minute, is he telling the Fed what to do? The White House has been adamant that this is an independent Fed, and the president has even said himself, I'm not going to do what the prior president did, which is, of course, tweeting directions at the chair of the Federal Reserve. I'm not going to tell them what to do, not going to try to thumb the scale. But we also have to back off here. Great, there's a meeting. It's going to generate some photographs. But the Federal Reserve is in regular contact with the White House, with the administration. Jay Powell and Janet Yellen have a weekly breakfast, and members of the Fed meet with the National Council of Economic Advisors on a regular basis here. So the fact that they're sitting down in the Oval for the first time since November is a bit rare. It's noteworthy. This may not be the big news event that a lot of people are looking for.
So, Joe, are you basically saying that Tom's conflating the BTS meeting at 3 p.m. with the 1:15 p.m. With Jay Powell isn't problematic to you at all because, frankly, they're both photo ops?
There's a lot to be said for that. And after the president's schedule that he held over the weekend, speaking at Arlington yesterday, Uvalde the day earlier, this is about hitting the reset button and reminding Americans that the White House is paying attention to gas prices and the issues that have them concerned at the kitchen table. This may not be a market mover
Lisa,
for Tom Keene.
I mean, Joe, you're giving me, she's spending way too much time in the Beltway. Lisa, middle-class America is getting absolutely crushed by the quality and the character of this inflation.
And frankly, this meeting coming after Memorial Day weekend is not completely coincidental, considering the fact that whether people were driving or whether people were buying stuff for their barbecues, you definitely saw a material difference. Joe, perhaps this is just a photo op, but how much pressure does this raise for a Fed to be aggressive? Because it's quite clear they're going to be the blamed child here, that basically Joe Biden's going to point the finger at them no matter what happens.
Well, I don't think it raises the stakes here. Obviously, this is a Federal Reserve that's already leaning into inflation. But in terms of what middle America is worried about and talking about, I'm going to remind you again that while you guys were reporting on global Wall Street in Davos, America was mourning the loss of these kids in Uvalde. And it was a conversation here nationally that took everyone's eyes off every other story. This is the White House getting it back on track, following a long weekend, to your point, where people all had to tank up and they're wondering if they can afford a vacation this summer.
Joe, I mean, I'm making a joke about it with the lyrics of Butter, which I know you've memorized, Joe. I didn't really know the lyrics. Rachel had to help me out here. But I mean, Powell really, for Fed independence, is going to sidestep right, left of my beat. I mean, I can't say this enough. They're not going to sacrifice the independence of the Fed, even if Yellen's a tough guy in the room.
Well, so there you go. And that's, I think, what you'll hear from the president today. They're going to have a bit of a confab here, maybe a couple of questions, a couple of photographs. You'll see them walk maybe to the colonnade. But this is not going to be a new routine where the president's getting together to tell Jay Powell what to do with interest rates or to browbeat the Treasury Secretary somehow. They want to look like they're on the same page, getting together, fighting what the president has said is the biggest challenge here to Americans.
Joe Matthew, thank you. Looking forward to the show a little bit later. Sound on Bloomberg Radio, weekdays at 5 p.m. A segment called What Normal People Read, TK, that apparently we should be tuning into a little bit later.
It's an important article. Joe features, this is zeitgeist this morning in Washington, but I do take your point, John, that this is about, and to be very honest, this is about elites who have a cushion against inflation and maybe the lowest of lowest decile doing better because the elites need the lowest of lowest deciles to service them, in a broad section in the middle with the Pew Research doing the best research on is flat out. The middle class, John, once again, early and often gets crushed given inflation.
And things could get worse. You saw the numbers out of JP Morgan, the investment bank, Brammer. We went through some of them in the last couple of weeks. They're saying we could have a cruel summer ahead when it comes to gas prices. We could have a 6 handle at some point in our future at the back end of the summer.
A lot of people seem to be thinking that is increasingly likely, and you can see it sort of damned if you do, damned if you don't with respect to gas prices, because even if you do get some sort of resolution to, say, the lockdowns in China, a positive for growth, it's a negative for gas prices. If you see some sort of ban take place in Europe, that's going to be a negative in terms of the affordability of gas prices. All of these things kind of coming together at a time when it does seem like consumers are still spending, even as their incomes decline, which really presents a conundrum for the Fed, because they really want to actually cause people to spend that much less? I mean, do they want to really crimp demand? Is that the only tool in the face of commodity-led inflation?
Brammer, big question. Have you ever heard Biden, Powell and Yellen described as the lads before?
The lads.
The lads.
I think I just did a couple
like
minutes ago.
How do you think Secretary Yellen would feel about that, Tom?
The Beatles. I mean, Yellen would know it's about the Beatles.
Let's ask her. If she's listening, she can call in.
Anyway, futures down 0.6 on the S&P. This is Bloomberg. Live from New York City this morning. Good morning. Here is your Tuesday morning price action. Futures are negative, down about 0.6% on the S&P. On the Nasdaq, down about 0.33%. Eating into some of the gains last week. Massive week of gains. First week of gains after a 7-week losing streak on the S&P 500. Some of that came from President Bostic of the Atlanta Fed teeing up a pause over at the Federal Reserve. Yesterday, Governor Waller pushing back against that, and you can see some of that in that bond market this morning. 2s, 10s and 30s look a little something like this. Yields higher across the board, up 8 basis points on a 10-year to 282.42, on a 2-year yield up by about 6 basis points to 254. Factor in the fact we've had some inflation surprises from Europe too, and a rally in this one, Brent and WTI. This has been a quiet one. I think Bank of America called it a sneaky rally. WTI 118.91, Brent crude 123.60. You remember back in early March through 130 briefly on WTI, Tom. We're creeping higher again, up by another 3 percentage points this morning.
John, I think it's important to understand you take the spot price right now and you compare it not to what people are doing on spot price months ago, but the moving averages. We've now exceeded a lot of the moving averages of March of this year.
Yeah, and we're looking at more gains ahead, potentially, Tom. And Brammer, you've been keen to point out less about what's happening in Europe, perhaps more about something Tom's been talking about for a while, China coming back online.
Shanghai loosening some of the requirements to ease up on some of the lockdowns. How much does this actually indicate a softening in zero COVID policies, even on a stealth level? How much is that really what's driving commodity prices, and how long, how many legs can that actually have?
TK is what you were looking for. Brent crude 123, WTI 118.
Worth watching there. And of course, what a joy in London to meet with Christian Malik and the JP Morgan team. They were just spellbinding on their model of $100 steady state out to 120 to 150 a barrel. Now, on this meeting today at the White House, Lindsay Piegza, chief economist at Stifel. Lindsay, I did a log extrapolation of a moving average of a gallon of gas in America. On the basic AAA unleaded, we're going to hit $5 July 11th, which for Joe Biden might as well be tomorrow. What does Powell say to the president to afford Fed independence and also not upset the June meetings and beyond?
Well, I don't know if there's much that the Fed can really tell the White House at this point regarding their policy pathway. Chair Powell has been very clear that they're going to remain data dependent, but they are focused on inflation. So if we continue to see these inflation numbers remain elevated, they're going to continue along with their 50 basis point increases. More than anything, I think this meeting is about the White House and about President Biden being able to convince the American people that he is very much focused on inflation. And by having Powell come to the White House, by having this roundtable, he's giving that perception to the American people that he's focused, that he's putting pressure on the Fed to do whatever they need to do to rein in inflation. So it's giving the appearance of the White House being focused, but it's also giving that subtle indication of finger pointing at the Fed that it's been a monetary policy mistake and not a fiscal policy mistake.
Okay, but that's the look back. We got to look forward, and the look forward is simple. Is job formation breaking? Are you seeing tea leaves of a labor slowdown?
Not yet. We still saw a very strong April employment report, and we do expect to still see a very solid, very positive May employment report, as the unemployment rate remains well below what the Fed has told us is their full employment range, well below 4%. We aren't seeing the indications of sideline workers coming back online. We aren't seeing indications of those 11.5 million job vacancies slowly being filled. We're still seeing a record demand for labor, and the supply side is falling well short. So we're not yet at a point where we can say that tightness in the labor market is beginning to ease.
Have we even seen peak inflation on a mechanical level, Lindsay?
I think it's too early to call the peak level of inflation. I know the market is very anxious to call peak prices, but as we still are waiting for some of the earlier pressures, as these second, third, fourth round of lockdowns that occurred overseas, remember, it takes months for those to seep into the data. So we haven't yet felt the true and the full impact of those earlier policy responses filter down into the numbers. Now, yes, we are taking steps in the right direction. As you just mentioned, China does seem to be easing some of those protocols. So we could see some price relief as we move further into the second half of the year. But at this point, as we're awaiting some of that May data, we look to June, those earlier policy measures are still going to provide upward pressure on prices.
Lindsay, some people say it matters where the inflation comes from. If it's supply chain driven, if it's commodity driven, then perhaps the Fed won't go as hard to try to crimp demand because, frankly, they don't need to create a real problem for the labor market and for demand just to deal with something that largely is considered temporary. Do you think that that's changing? Do you think that that nuance has no place at this point?
No, I think the Fed is very aware of the fact that the vast majority of price pressures have stemmed from the supply side of the equation, rendering traditional policy metrics less effective. To your point, as the Fed raises the cost of capital, that can tap down consumption and tap down investment, but it does nothing to alleviate the price pressure stemming from these supply chain disruptions still lingering in the aftermath of the COVID-19 crisis, or those being exacerbated now by international conflict.
Not that they're going to play the parlor game in the Oval Office today, but what's your terminal rate now? Are you in a lower 3% band of where the Fed's heading, or do you go gloomy and show a restrictive Fed out above 4%?
I think the Fed is very aware that the U.S. economy is already showing signs of easing, that we're already seeing cracks in the armor. When we look at the consumer, yes, they're still spending, but why are they spending? How are they able to spend? They're now drawing down savings at a very marked rate. And so going further into the second half of the year, where is that support coming from? It's likely to ease precipitously. So the Fed does have to acknowledge that. I think they are acknowledging that. And I think we move into 25 basis points sooner rather than later.
Okay, I guess that's something that President Biden wants to hear. What part of 7 or 8% inflation then is transitory? Do we go back to 5 or 4, or dare I say the nirvana of 2%?
Well, I think the Fed is very optimistic that they're going to see lower levels of inflation, but they're not forecasting 2% inflation anytime soon. For the Fed, it's about the directional momentum. And the Fed is optimistic that in the second half of the year, we'll continue to see a slower pace of price appreciation. So that second derivative decline coming into realized territory. But in 2023, that's where the Fed is very optimistic that we're going to see this precipitous downward trend in inflation towards 4%. Maybe even 3%. But getting to that 2% or below, that's going to take several years' time before we get to that range.
The intention to get inflation down, Lindsay, is one reason why Mike Wilson of Morgan Stanley thinks that this is a bear market rally and that there's more downside. Because frankly, anything that was a Fed put earlier is going in the opposite direction. The Fed actually wants to see a tightening in financial conditions and won't be happy if there's too much of a rally, if yields come in too much, because frankly, that moves in the opposite direction from what they're trying to achieve. Do you agree with that? Do you think that there is a sort of eye toward the markets and what that means for financial conditions by the Federal Reserve?
Well, remember, the Fed is very much focused on financial market stability. They're not targeting yields per se, but yes, they would like to see the market respond to what the Fed has already done. That being said, they have other tools in their tool belt to continue to push, especially longer rates higher. Drawing down the balance sheet, they're going to be ramping that up. If they're not comfortable accelerating the pace of rate increases, as we suggest, the economy is already slowing. 50 basis points may not be doable as we move into the fourth quarter or even later in the third quarter. They can resort to balance sheet reduction at a faster pace, which will provide nice upward pressure to the longer end, or at the very least, provide a floor to longer rates.
Lindsay, just quickly, if I'm in this market, I just want the answer to one question. Who do I listen to? President Bostic or Governor Waller?
I think at this point we need to listen to both, because what that tells us is that policymakers themselves, it is a very economist answer, absolutely. But I think this tells us that policymakers themselves are uncertain about the direction of rates, that there's a very fruitful debate going on among policy officials as to where the economy is going, where rates are going to go, and that's going to, I think, add volatility to this marketplace. So investors need to be aware that there could be some sort of change up, if you will, in terms of the policy pathway. It's not on a predetermined course.
Lindsay, thank you. Lindsay Piegza there of Stifel. Bramo, I don't think we've cleared that one up.
No, I think that that's been really the toggle that you've seen in markets, as you pointed out, with last week, the really presiding sentiment being Raphael Bostic, and now suddenly Christopher Waller's coming out and taking the main frame. How much are they going to be able to go aggressively, given the concern about labor market and, frankly, the knee-jerk reaction within the Fed over the past 2 decades to go easy and not to necessarily go hard?
John, I think it's just an incredibly important meeting today. Thanks to John Plender over the FT for reminding me of his classic photo. This is a tennis player, Alan Greenspan, in an Oval Office type meeting. I mean, John, I could see this today at the White House.
You think Chairman Powell lying down in the Oval Office, Tom?
Yeah, Powell lying down, maybe Yellen will take a nap as well. This is Vice President Cheney. For those of you on radio, this is a classic photo of the tennis player, Alan Greenspan, working his back. He had a terrible back, I guess. So.
TK, a difficult moment for this White House. And as Joe mentioned about 5, 10, 15 minutes ago, it's about the optics, isn't it? We're doing something about it. Maybe don't look at us, look at them.
It's about the optics, yes, but much more, it's this huge, once-in-a-lifetime crisis that we've had 3 times in 15 years, the great financial crash we had the pandemic, and now we've got a war in Ukraine linked into the China lockdown.
And Tom, leadership all over the place, not just in the public sector, the private sector too. We've seen it from company to company, from industry to industry. They are struggling to judge where they need to be 6 months, 12 months out for the demand that exists at that point.
The uncertainty is off the chart, and someone very good at this will be the Secretary of Treasury, Janet Yellen. She's expert on modeling out the language of uncertainty to our president.
Futures right now down about 17 on the S&P. We're negative 0.4% on the NASDAQ 100, down about a tenth.
Dow futures down 134.
I bet you had a good time last week with that, didn't you? Yeah, a lot of fun.
Brian Moynihan wanted to hear Dow futures.
Did Brian actually want that? Did you ask? Did you ask for the Bank of America Dow year-end forecast?
Yeah.
Does that exist?
Yeah, it does.
Does it?
He did name check you every time he talked about the Dow, just to let you know.
Who's got a year-end forecast on the Dow? Pick a bank. Who's got one?
James Stavridis.
Has he? We'll get that shortly. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. European Union leaders have agreed to back a partial ban on Russian oil. It would be part of a sixth package of sanctions aimed at punishing Russia for invading Ukraine. The sanctions would ban the purchase of Russian oil and petroleum products delivered by ships, but it temporarily allows EU nations to buy Russian oil delivered by pipeline. That exemption is needed to get Hungary to sign on. Inflation in the Eurozone accelerated to an all-time high this month. Consumer prices rose a more than expected 8.1% from a year ago. Food and energy were the big reasons. The data will intensify the debate at the European Central Bank about how fast to raise interest rates. And President Biden says there are limits to what he can do about guns. Over the weekend, the president visited the Texas elementary school where 19 children and 2 teachers were killed. He has renewed calls for Congress to crack down on the kinds of assault weapons that were used to carry out the killings. And more legal headaches for Deutsche Bank. Police in Frankfurt raided Germany's largest lender and its asset management unit, DWS. The search is related to accusations of so-called greenwashing by the asset manager. There have been claims that DWS was marketing investment products as being greener than they actually were. American investor Todd Boehly has completed his $5.4 billion takeover of Chelsea Football Club. That ends almost 2 decades of ownership under Russian billionaire Roman Abramovich. He was forced to put the team up for sale earlier this year, shortly before being sanctioned as part of the response to Russia's war in Ukraine. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
It should be a full energy embargo, oil, coal, and gas. We, before the war, were about 90% Russian gas dependent. We are no longer buying any gas from Russia. I also don't see the point of talking with someone who's committing genocide in a neighboring country.
That was Latvia's Prime Minister speaking to Bloomberg's Maria Tadeo. We'll catch in with Maria a little bit later in the next hour. Futures this morning on the S&P look like this, negative 0.4%. On the Nasdaq, down about 0.1%. Some of that crude conversation, 118.73 on WTI, up by more than 3%. Wow. Brent crude, a tidy move through 120. Yield higher by 8 basis points on a 10-year, in and around 282. You can thank Governor Waller for some of that move higher. Thank Europe for some of it too. Just upside surprise after upside surprise in the Eurozone on inflation. Euro dollar 107.30, that currency pair negative about 0.5%, Tom. The big one next Thursday for President Lagarde.
Well, it's going to be next Thursday for Lagarde, but also the economic data this weekend of the jobs report is not going to be a small idea. John, quickly here, tomorrow, June 1, those first month data that we get, what are you looking for?
I'm looking ahead to payrolls, Tom, and looking for some deceleration in payrolls growth, because that's what a lot of people are looking for. The JOLTS data, that's going to be a focus for some, Tom, but that JOLTS data is really, really dated. Yeah. So if you're looking for job openings to confirm a move over at the Federal Reserve, then that Fed is going to commit to being a little bit late.
And the housing data today is dated as well. That's in this fast-moving 2022 important. It is a joy, and it was my book of the summer a few years ago. Stavridis and Ackerman way out front on the tensions with China, looking out to 2034. Now it is vintage Stavridis, and he joins us this morning, the Admiral, with To Risk It All. And this is what he does best. This is 8, 9, 10 chapters, 9 conflicts, 9 chapters on people in the Navy and lessons learned of their successes and their failures. I want to fold this, Admiral, into where we are right now. And this is off my conversation in Davos with Sir Lawrence Friedman as well on the Black Sea. You were first, I heard, on the Black Sea. William Halsey was out of Pearl Harbor in 1941. He came back. He supported Nimitz. He supported the Navy under a lot of heat. And then he went out to sea aggressively. How do we be aggressive in a Black Sea contained by the Bosphorus Strait?
The Black Sea is a Russian lake right now. Their Black Sea fleet controls it. But here's the good news, Tom. There are NATO allies around that Black Sea, including Turkey, Romania, Bulgaria. We have NATO warships in the area. The United States can flow warships that are currently stationed in the Mediterranean Sea. I think we need to look to the sea because of grain, because of agrarian products. bottled up in Ukraine. At some point, the international community, I believe, is going to have to consider escorting grain tankers in and out of Odessa. Right now, they're choked off. That's going to lead to maximal impact in North Africa. We need to open the seas to Ukraine. I think that's the next big muscle movement in this war.
Are we measuring risk correctly? Let's look at Admiral Halsey in your book and the idea that he got a lot of things right and he had a most difficult 1944 in the Philippines. We're worried about failure like Admiral Halsey faced failure. Are we overemphasizing failure?
I think we are not. And let's take it to Ukraine, where you see two risk takers, right? You see Vladimir Putin, who has really rolled the dice in a very big way. And I don't think it's going to come out well for him because he has no moral grounding. On the other side of the coin, to your question, Tom, you see someone like Zelensky, who literally is risking it all, his family, his parents, his civilization, his cities. That's pretty motivating. And I think at the end of the day, with the tools the West are providing him, his risk calculus is going to be the correct one.
Okay, so Admiral, if Vladimir Putin is an example of failed leadership, why aren't they losing more quickly?
Well, they are losing very quickly as follows, Lisa. You'll recall 3 months ago, every prediction was that they were going to sweep across the country, conquer Kyiv, decapitate the Zelensky regime. None of that happened. Plan A, total failure. So now they're back to Plan B, which is a much more modest approach in the southeast of the country. And they're doing better by comparison with their failures at the beginning. But I wouldn't categorize what I'm seeing right now as a lot of success on the Russian side.
So then it brings us back to the Black Sea and your idea of possibly escorting grain ships from Odessa. How aggressive should the Western allies get in the face of dramatically weakened leadership by Vladimir Putin? Is it time to be more aggressive, or is it just to continue this sort of grinding it out kind of approach that we've been seeing for the past couple of months?
Yeah, the mistake here is to think that it's some kind of on and off switch, that either we go to war with Russia or we just sit back and let them conquer Ukraine. I think the West has correctly treated it like a rheostat, like the dimmer in your dining room, and is cranking it up, taking more risk, back to the conversation I just had with Tom, taking more risk in prudent ways. And I think in that case, when I look at the grain shipment, it's time to take a look at that.
Admiral Stavridis, what can anyone from England learn from the power of no and John Paul Jones? This is a few years ago, and Mr. Jones went over to England and took on Britain. What do we learn about the power of no?
In one word, determination. And here you have a relatively ragtag American Navy in the 1770s. And John Paul Jones inspires it by fighting from the deck of the Bonhomme Richard and defeating a British ship, the Serapis, in 1779. It's an extraordinary story in which he utters the immortal words, immortal to the Navy, and I would argue to anybody, I have not yet begun to fight, even when looking defeat in the eye.
Well, Ferro says that once a week.
I was wondering where you were taking this, Tom, as you set up that conversation. Admiral, thank you. Admiral James Stavridis there of the Carlyle Group, thank you very much. TK, opening the sea, you've been talking about it from the very beginning of this conflict.
I'm sorry, this goes back to a cold winter 20-plus years ago, John, in, of all places, Amherst, Massachusetts, and I read everything I could on Russia history. They always look south. They always look, in every circumstance, to the Black Sea.
And Tom, food and energy at the heart of some of this conversation.
Well, it is, and that hasn't moved today. I mean, on the daily basis, I really don't see wheat popping yet or corn. They've actually done a little better recently. But I'll tell you, John, seriously, in Davos, every conversation circled back to Odessa. It doesn't matter if you spell it with one S or two S's. That is the focal point right now in terms of the food, the food and the Arab Spring memories of Tunisia. I'm sorry, Odessa is the fulcrum point right now.
Peter Oppenheimer is going to be joining us shortly from Goldman Sachs on this equity market. Stay tuned for that. Here's your setup in the equity market right now. Futures are negative on the S&P 500, down 17 or 18 points. We're down 0.4%. I'm sure many of you saw the comments from Governor Waller yesterday of the Federal Reserve talking up higher interest rates until inflation starts to get closer to 2%. That unleashed a little bit of a sell-off in the Treasury market. Yields higher by 7 or 8 basis points to 281.33. Over in Europe, more upside surprises, just the wrong kind of upside surprises. Inflation heading in the wrong direction still. Euro-dollar negative 0.7%. From New York City, this is Bloomberg.
Consumers are dipping into their savings, and that's what's sustaining the health of consumption in the US.
The consumer is really the most important data point here.
The Fed's not going to come to the rescue. There's no V-shaped recovery here.
The market has tightened a lot for them already, and they've only done one small 25 basis point rate hike and a 50.
I think the Fed is going to have to decide between two policy mistakes.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
From a steamy New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures negative on the S&P by 0.4%. TK, big day ahead. Big week ahead too.
Yeah, big week ahead up to the jobs report here. We're getting some June data out tomorrow. And what does it matter? And as you mentioned in the last hour, John, the changes now are so abrupt. The data really doesn't matter. I'm really not going to matter about Case-Shiller, et cetera. What I want to know is the pulse right now. And in the Oval Office this morning, that's what the president's going to ask of the chairman.
Inflation, nothing else matters right now. And it's not just in America. It's Europe too. We talked about it earlier this morning. The numbers out of Germany, out of Italy, out of France, out of Spain, out of Europe, the Eurozone, an 8 handle, Tom, an 8 handle in the Eurozone.
Yeah, J.P. Morgan, I've been reading their 100-page opus, maybe the research piece of the year from Christian Malik and the team. And John, GDP of hydrocarbons is about 9% globally. So every time you see that oil price tick up, it permeates throughout the system.
Bramo, driving season starting in America. Crude 118 on WTI. Gas prices, they keep climbing the wrong way for this White House.
Yeah, to new record highs, and a lot of people are trying to frame out a $6 a gallon of gas. We're already seeing that and beyond in certain areas in the United States. What does this do to the buying power, to the willingness of American consumers to absorb higher prices? Because right now, the CEOs that we spoke to last week, and frankly, even the business owners that I speak to casually day to day, say that there really is no limit to how much they can hike up prices, and that's a bad thing for the Fed.
They can't get a read on this economy, though. Let's be clear about that. We've seen it from company to company across industries that they're struggling to gauge where we are in this cycle. They've set up their companies for where we were 12 months ago. We're not there anymore. We saw that at Target. We saw that at Walmart. We saw that across the retailers, from being understaffed to overstaffed. And they were clamoring for supply, Lisa, and maybe in some places they've got too much of it now.
And this is the reason why you asked a really good question about what it means to see massive price swings in some of these shares after a downside surprises and margin pressures appearing on their earnings statements. How much are we starting to see them actually gauge out a more optimistic future than the reality? We saw the opposite of that for so many years. Are we starting to see now the CEOs unable to get out ahead of just how much they're going to have to pay workers and just how much the commodity costs are going to bite on their operational expenses?
Without a doubt, across a whole range of issues. Tom, can they provide any guidance now whatsoever?
Absolutely not. And, the guest we have coming up here to lead off, please stay with us for Peter Oppenheimer. But, John, I'm going to suggest it goes right to the revenue line, which is the unit dynamics and the price dynamics in this high inflation environment. And as Chris Crisanti mentioned earlier, Chris Morangi, rather, with Gabelli mentioned, when was the last time we talked about LIFO, FIFO inventory? We're in a new era, which harkens back to an old era. And again, the president knows that old era.
That president has a key meeting a little bit later this afternoon. We'll get to the details of that a little bit later. Let's get you up to speed on what's happening with the price action as Wall Street gets back to work this Tuesday morning. Good morning to you. Futures negative 1/3% on the S&P, on the Nasdaq 100. Pretty flat right now. Considering what we're seeing in the bond market, may be surprising somewhat. Yields higher by 7 or 8 basis points on a 10-year, 281.33. Last week, Bramo, it was President Bostic saying maybe we have a pause later after the summer, and Governor Waller having none none of it yesterday afternoon.
Frankly, looking at the inflation data, and just to give you a sense of that, we saw mortgage levels come down, mortgage rates come down last week, the most going back to 2020. And yet we are continuing to see the price pressure go to the upside. We're going to get the latest read on that at 9 a.m. with a slew of housing data, including the FHFA, as well as S&P CoreLogic house price data. Year over year, we have seen record increases in housing prices, despite mortgage rates that are increasing, despite all-in costs that are creating a real prohibitive environment for a lot of potential clients. A very concerning mix. Meanwhile, we are going to get at 10 a.m. a read on consumer confidence. We get the Conference Board U.S. consumer confidence data. How much do we see an ongoing decline in how much the American public has in terms of optimism as we continue to get downside surprise on the economic data after downside surprise? And at 1:15 p.m., U.S. President Biden is meeting with Fed Chair Jerome Powell, as well as Treasury Secretary Janet Yellen on inflation. How much can they talk about bringing up the unemployment rate? This is the unpopular reality of rate hikes. How much does this actually end up with more people unemployed or a worse hiring environment? John, that seems like the only potential outcome. How do you dovetail that message if you're the leader of what a lot of people think to be the free world?
As Tom said repeatedly through the morning, the lads getting together in the Oval a little bit. I'm still getting my head around that. In the Oval Office a little bit later, Lisa.
Yeah, and honestly, I do wonder whether this is just a photo op or whether this actually creates. I actually would agree, because if it's a photo op, it actually creates a liability for a Federal Reserve that's facing off with accusations of being overly political, of being behind the ball. Right. How does this get positioned, into a kumbaya moment?
There's no kumbaya. 30-second history. Truman and McChesney Martin invented the modern Fed. I'm going to guess 1951. John, flash forward to the same inflation worries of Vietnam War, LBJ, and again, McChesney Martin, pressured, and then you go over once, twice, Nixon and the rest. This is a reoccurring theme, and Powell's got to stand his ground, and frankly, he's working with a president who's gracious and will let him do that.
Without a doubt, Tom, this administration has blamed everything under the sun. Price gouging, supply chains, Putin, Russia, take your pick.
AC Milan.
Not Milan, but none of it sticks, Tom. None of it sticks. And you've seen what it says in the polls. That's how people feel about this White House when it comes to this issue.
Now, let's get to our guest, John, but this inflation is entrenched, and we saw that this morning in Europe.
Joining us now is Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. And Peter, you put out the note yesterday, so let's start with your research. What happens after you've seen peak inflation? So work through it with us. Have we seen that? What happens next?
Well, I think that if you look at the history for markets, at least, when you get peak inflation, you do tend to get a recovery in risk assets. And that's generally because it starts to alleviate pressures on interest rates. By that stage, you've usually had markets already pricing in an economic downturn. So at the point where people think that things are bad but getting less bad, you tend to get a recovery. But it's important to say that there are variations around this theme. After all, when inflation peaked in 2001, markets were still falling because of the fallout from the tech bubble. And similarly, that was true around the financial crisis. So I think we've got to be a little bit circumspect about this. Generally, I think if inflation peaks, it will provide some relief. But there's still the ongoing uncertainty about the scale of the slowdown in growth. And until we get more evidence that the rate of deterioration there is slowing, I think markets will be a bit volatile in the short run.
Peter, paint a picture of how corporations adapt, not sector to sector, but as a general statement, giving new, almost jump condition move in inflation. How do corporations adapt and adjust?
Well, I think there are two things that are important to say. One of them is that, inflation is generating higher nominal GDP. In a sense, growth is not the problem. To your point earlier, Tom, the problem is margins and bottom line. Equities, companies are making a claim on nominal GDP growth. Nominal GDP is actually quite high relative to the last decade. The question is how they can cope with higher costs, what that does to margins, what that does to earnings and the bottom line and their valuation. I think the second point to mention is that we're in an environment now which is very different to the one we've seen in the last couple of decades, when both commodities and labor were easily available and relatively cheap. And now we're in an environment, probably structurally, where both commodities becoming more scarce, more heavily contested and competed for, more expensive, and labor as well. I think what that will do is encourage more companies to invest in greater efficiency, like we saw in the 70s, more spending on innovations to become more energy efficient and substituting, to some extent, technology for labor as well.
Peter, how does this all play into being overweight both equities and cash, which doesn't seem to make sense, given the fact that you see bonds as actually being the biggest underperformers here?
Yeah, I mean, in a short-term horizon, we're actually neutral of equities, overweight for cash and commodities. On a 12-month view, we are actually overweight for equities. And I think it's important to emphasize that relative to bonds, there's still some reasonable return, I think, to be got in equities over a 12-month horizon. First of all, valuations have come down a lot. Actually, profits have held up so far very, very well. If you look at most equity markets, they're trading now below long-run average valuations. That's true across Europe and across Asia and EM. Not true in the US. The US is still trading above its long-run average valuations. But I think there are some, attractive valuations that are coming through. Earnings, we think, will grow with stronger nominal GDP, albeit at a slower rate. The problem is valuation, because obviously with higher inflation, higher interest rates, you're not seeing the valuation expansion that investors got used to in the last cycle. So I think taking those things together, on a 12-month view, we think there's some good opportunities in equities now.
Peter, wonderful to catch up, and congrats to your Tottenham for a top 4 finish. I know you wanted me to squeeze that in there somewhere. Thank you, buddy. Peter Oppenheimer there of Goldman Sachs. Thank you. TK, tough moment. I've said that repeatedly through this morning. This is a really tough moment.
It is, and it's the character of the inflation. And again, I'm going to go back, John, to yes, there's inflation in certain ideas, but to me, it really centers on oil and gas and on hydrocarbons, on the distillates, and how it filters through the system. And how do you work that away? I mean, remember transitory, John?
Oh, yeah.
90 days, it's all over.
Do you remember that, Tom? That drinking game that we used to play on this show?
Yeah.
No one talking about it anymore.
John, the Tang in Switzerland just
what was that like?
It's not the same.
Was it spiked Tang? That's what we all want to know.
No, but it's not the same.
I saw that video going round of you, looking absolutely disgusted, appalled, in fact, by whatever you were drinking. What was that?
It was a Kirsch. I think it's called a Kirsch. It's like pears and plums.
People want to know, Tom, did someone water down your scotch?
No, it was not
what
scotch.
Happened?
No, we don't allow that on set.
Of course not, never. Of course not. Futures down 0.2 on the S&P from New York City. Great to be back in the seat with the team. This is Bloomberg.
Of course.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. European Union leaders have paved the way for a 6th package of sanctions to punish Russia and President Vladimir Putin. They agreed to pursue a partial ban on Russian oil. It would forbid the purchase of crude oil and petroleum products from Russia delivered by sea, but there would be a temporary exemption for pipeline crude that would satisfy Hungary, which gets Russian oil via pipeline. President Biden will hold a rare Oval Office meeting today with Federal Reserve Chair Jerome Powell. Treasury Secretary Janet Yellen will join them to discuss what the administration calls the president's top economic priority, inflation. Rising prices are hurting the president, with voters just months before midterm elections. And for the first time since early March, the number of daily coronavirus cases in China has dropped below 100. Still, Omicron's contagiousness means the reprieve from infections and the tough COVID-0 response may only be temporary. Both Beijing and Shanghai have started to loosen restrictions on mobility. Hurricane Agatha hit Mexico's Pacific coast with high winds and heavy rain. It's expected to be the strongest May storm ever to strike the eastern Pacific. Agatha was rated just below Category 3 on a 5-step scale. There's concern that even if the hurricane loses strength over land, remnants could cross into the Gulf of Mexico and form a new storm there. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I thought the Fed's posture at last was broadly appropriate, and now the question's going to involve carrying through. But I do continue to believe that a soft landing is an unlikely outcome.
That was Larry Summers, the former US Treasury Secretary, coming very close to a compliment for the Federal Reserve just then, Tom, saying at last broadly appropriate, the stance, and then finishing by saying a soft landing is an unlikely outcome for this Federal Reserve.
He's hit the ball out of the park on the inflation dynamic, and I'm going to give him some credit on GDP because nominal GDP masks a stagflation, John, for a large part of the audience. Real GDP is under 4%. That's still elevated. I get it.
Yeah.
But for a huge part of America, we're getting staggy quicker than maybe we thought.
I'll whip through things quickly, Tom. Futures down 0.4 on the S&P, just a bit softer this morning. And good morning to you all. On the Nasdaq, we're down by not even 0.1%. Yields are higher, though, as we reopen and get back to work on Wall Street. Yields higher by 7 basis points on a Treasury to about 281. Governor Waller responsible for some of that. And then, Tom, just that sneaky move. We keep going back to it, TK. 118.26, crude up by almost 3%.
It will be interesting to say the least. We're going to do what we do on Surveillance Best, which is digress here. Joe Matthew and I are trying to get the Red Sox above 500. Maria Tadeo hasn't slept in 5 days off of the stunning win of Real Madrid against Liverpool. And then there was a problem. There were terrible protests in Paris. John Farrow, help me out here. I'm not up to speed on this, but Maria, as a first question with John's expertise, this is another example of the fragility of EU confidence when you can't even get protest in Paris correct.
I'm not sure if I agree. I think what that shows is that Real Madrid is the best team in the world and got vindicated on every front. As a team, won the Champions League. As a city, was just better organized. I'm not sure it comes down to the functioning of the European Union, but more the greatness of what is the best team in the world.
I had a feeling you would go there, Maria. I had a feeling you would go there. You've had your moment.
Did she get the script?
TK,
I mean, did she get the script?
What happened was this final got taken off Russia and was given to France, to Paris. And Maria, the policing of this final, according to many people who were there, many people who have experienced it, was absolutely terrible. What went wrong and how big a story is this in Europe now?
Look, I think right now, if you step away from the world of finance, and I know for us it's very difficult, but if you step down into what people talk about at the restaurant, at the bar, and when they have a drink, it is probably the biggest story right now in Europe. I mean, it's Champions League. This is the biggest match that we have other than the World Cup. It is two big teams. It's, of course, Real Madrid coming off that saga of Mbappé not joining the team, but nonetheless winning again for the 14th time in history. No one has ever done that, just as a matter of fact, for the record. But I think it also shows that this was just a terrible, terrible organization. It was a big failure. And what you see here, however, and this goes back to some of the politics here, is that the French, they blame, of course, the English fans, saying a lot of this was bad behavior. The English fans who paid for a ticket and who were there, they say it was bad policing. And when you talk to the Real Madrid fans, they say, well, we don't care because we won the cup. I mean...
Yeah, Lisa, have you ever seen Maria more engaged? I don't believe I have.
Well, she was pretty engaged when she was telling you how to pronounce Javier's last name. I do want to, though, just dovetail this, Maria, this sense of how we look at what people are talking about in bars and restaurants. And it is this feeling of discontent, perhaps not just this match, but also more broadly, of the higher gas prices, the higher utility bills, the incredible inflation surge that's a record over in Europe. How much is that eroding the willingness to have a ban on oil and gas from Russia, from taking a hard line and looking to the quality of life at home?
Yeah, I think we're now at a point in which this war is, of course, affecting the consumer. We see it on the inflation print. We saw it today. There's been this agreement on this oil ban, which I would say on a serious note is actually pretty significant. The Europeans say that if everyone plays by the rules and they do what they say they will do, by the end of the year, you're looking at a 90% reduction of Russian oil exports into the European Union. So that is pretty significant on the detail, but it does bring up a good question, which is what happens next? How many sanctions? What else can the European Union do? And the big question is gas. And I spoke to the Belgian Prime Minister right here, and I put that question to him. Are we now going into gas? And he told me, for the time being, we need to take a breather. I think when it comes to energy, we've reached the limits of what we can do on the short term because we need to really assess the second round effects of all of this.
Joe Matthew, no one in America cares about Real Madrid and Liverpool, but we do care about the next step of the White House on Ukraine. What is the next step given the action in Brussels?
The next step is apparently to take a step back here, Tom. There was talk about these long-range missiles that President Zelensky has been asking for weeks. And just yesterday, even amid reporting over the weekend that the U.S. was putting together a new weapons package, the president was adamant to say that we're not going to be sending those missiles, known as MLRS, multiple launch rocket systems. This would allow, in terms at least regarding this standoff in the Donetsk, the president says would allow Ukraine to lob missiles into Russia. That draws the line between what's considered defensive and offensive weaponry. This is a new line that we're drawing here, much like we did with the MiG-29s. And interesting, as they go back to the drawing board here to see what weapons we can send Ukraine, we're now starting to eliminate some of them here in Washington.
Hey, Joe, looking forward to the show a little bit later. Sound On, weekdays at 5 p.m., Monday to Friday with Joe Matthew. Looking forward to that. Did Maria ever tell you the story, Tom, about how Real Madrid were the greatest team in the world?
No, I think I missed that.
Do you want to tune in again for that a little bit later? Joe Matthew's going to have Maria Tadeo on for a full 30 minutes.
Oh, very cool.
On Bloomberg Radio to talk about how Real Madrid is the greatest
Joe,
team
I'll have to brush up
in the
on
world.
that.
TK, you should have known better. Once you bring up Real Madrid and Maria.
She just looked like, boom. I mean, she's just
Over.
like that. Should they bring Gareth back to the tots? I mean,
You'd like to
after what
see
he
that
did?
happen,
Yeah.
wouldn't you?
He kicks the ball from far out. He's exciting.
Isn't that your bottom line for everything?
Yeah, it is.
That's basically the
Sorry.
threshold. Bramo, this is how TK establishes whether someone is a good or bad footballer, whether they kick the ball from far out or not.
Well, his
That's
football,
the extent of the analysis.
His football analysis also
Is he too old, John?
This is
Seriously.
where they use their foot, not their hand, to throw the football.
There you
Because
go.
we're talking
Well,
about
Tom,
a different
actually,
kind
bottom
of
line, he's a
football.
tremendous golfer and spends a lot of time playing golf, Tom. And I wonder whether in the not too distant future he thinks about doing that full time.
Okay.
In his own time, not to become a professional, but just to do that instead of playing football.
Oh, a message from Al from New Jersey.
What's
Can
Al
you do
saying?
any more soccer?
I think we're done. I think we're done. Bloomberg style, Tom, is football now, not soccer. You know that. You know that.
Yes.
It is. It's in the rule book. Futures this morning, and good morning. We're down about 0.5%. For those of you who like football, you've missed me, and if you don't, you probably haven't. I apologise for that. Yields are higher by 7 or 8 basis points on a 10-year to 281.33.
Quote a gallon of gas in Capri.
Ton of economic data coming out through the week. I imagine it's pretty expensive.
It's
Tom.
$7. It's like.
Do you actually know that for a fact? Are you making that
yeah,
up?
but you had the Renault.
not in
so-
dollars.
If you just made a number up.
In Capri.
No,
It just
Capri.
made it-
The
okay.
gallon of gas in Capri is $7.69.
Live from New York City this morning. Good morning to you all on TV and radio. Here is your price action. Down about 0.5% on the S&P. On the Nasdaq, down about 0.1%. Last week, snapping 7 straight weeks of losses on the S&P. It does not take much of a spark to start a fire in a market that hasn't seen gains in about 2 months. And last week, all it really took was one Fed official to come out and say maybe we could have a pause later this summer. Some of the data might validate that. Maybe you saw some of that in the minutes, confirming your priors from the Federal Reserve minutes last week. Well, Governor Waller yesterday gave that one a bit of a backhand. And this is what Treasury yields look like this morning. 2s, 10s and 30s yields up across the board through the curve. 2s, 10s and 30s yields higher by 7 basis points on a 10-year to 281, on a 2-year by 5 or 6 basis points to 253. Tom mentioned the data, tons of it. You get jolts, the ISM, payrolls later this week, all of that good stuff. Throw in China reopening. That's an important data point, and push that through this commodity market. WTI and Brent, I think it was Mr. Hartnett over at Bank of America called this one a sneaky rally, Tom. It continues. WTI up by more than 3%, 118, and let's round it up to 80.
The persistency there is valid, but also I'm going to look at renminbi, John. You had a stronger renminbi all in all, 6.66 yuan. So there is a little bit of movement to watch in EM, and particularly off renminbi about the China reopening.
Bramo, that demand just given this commodity market a bit more of a kick.
Yeah, and frankly, we don't know how long it's going to last or how robust it will be, but it just adds to already this feeling feeling that the only reason why oil prices haven't been even higher is simply because there has been less liquidity in markets. And so people haven't been able to put as much down on options and futures trading, which is really remarkable to me.
Brent crude right now, 123. That's the cross-asset price action. Let's get you some single names, some movers this morning. Let's say good morning to Romain. Good morning, Romain.
Hey, good morning, John. Well, here in the month of May, 7 of the top 10 stocks in the S&P 500 are energy stocks, and that's kind of the story this morning, looking at Brent crude above 124 at one point here on the day, and WTI above 113. ExxonMobil up about 1% on the day. Occidental Petroleum, best performer in the S&P on a year-to-date basis, higher by about 3% here in the pre-market, as a lot of people now start to look at that churn, not only with regards to crude oil, but of course with some of those refined products and the persistent price increases that we're seeing there. And of course, what's good for an Exxon and an Oxy, not necessarily good for the travel space. American Airlines shares down about 1.3% here in the pre-market, as are most of the other airlines, despite an attempt last week to stage a little bit of a rally, a 3-day rally there. We should point out American Airlines going to end the month down here, barring some sort of big reversal here later in the day. You flip it up and take a look at what's going on over in China. You mentioned that, Tom, with the with the reopenings there. JD up about 6% here on the day. Alibaba and the rest of the Chinese ADRs also getting a bit of a bid. And keep an eye on some of the U.S. companies that have a big exposure into China, like Tesla and Apple, also getting the bid here as well. Movie theater stocks higher here this morning, with AMC Entertainment up about 7% on the back of that really good showing of the new Tom Cruise reboot of Top Gun. 124 million at the box office just in the U.S. and Canada alone. That was the biggest theatrical release that we've seen so far on a monetary basis since the pandemic. And after the bell tonight, Tom, we're going to get some more earnings, believe it or not. Salesforce coming out after the bell. Those shares slightly higher here in the pre-market.
Romain Bostic, thank you so much. To close this afternoon. Right now, we want to jump to Laura Rahm. She's chief U.S. economist at FS Investments. I think we've talked a fair amount about the meeting to be held today. Laura, let me go to the makeup of inflation. What is different about this inflation versus the inflation of previous times?
So this inflation is really coming from everywhere. And I think it is so important to stress the food and energy component of this, because we're used to seeing volatility at the gas pump, but the just really ominous continued climb of food prices has given this combined basket inflation of over 17%. And while the overall inflation, CPI did likely peak in March, but food and energy is still climbing, and it is so punitive. It is punitive. Every household in America needs to buy these two things, and it really is making the Fed look more disconnected. Their focus on core inflation looks like it's way behind the curve.
Right. So, Laura, we showed earlier the famous photograph of Alan Greenspan laying on the floor because of his bad back. So you're in the Oval Office today, and they're doing couch time, Yellen, Powell, the president, and Laura Rahm is laying on the floor with her bad back. Laura, what do you tell them about the when of inflation coming down if they just do a prescribed Fed policy?
So, what I would tell them is they need to front load these rate hikes as much as possible, because we know that there's only so much they're going to be able to impact some of the supply chain disruption factors that we've had, energy prices, given that there's such a, again, geopolitical component to that. I would tell them to front load and then take a very data dependent approach come September, come December. The reality is, I don't think they're going to be able to raise as much as markets have priced in.
Laura, why are we not seeing consumers pull back at all? Why are we seeing spending continuing to be so robust, despite some of the sentiment reads that have been negative?
We'll get the other consumer confidence data later today. I do think that you're having this tug and pull between households that are badly concerned about inflation, but are still supported by a healthy job market. That said, the components of spending are clearly shifting. I think we have less spending on durable goods going forward, less spending on non-durable goods. There is going to be a focus on services over the summer. I think it's the back half of the year that gets very uncertain. And that's where I'm concerned that people are going to have their summer vacation. They've been waiting for it, and the kids are clamoring to go to Disney World. But come the fall, with food and energy prices still sticky and high, people really at that point change into savings mode and try to rebuild that savings.
So it has to do with the labor market. We get the latest read on the labor market this Friday. 2021 was notable for revisions. for the upward revisions that changed everybody's view dramatically of a labor market that looked from like it was decelerating to one that seemed like it was red hot all through the summer. What kind of revisions can we expect? What do we see in some of the second and third reads of what we've seen so far this year?
You know, the data collection, I think, is still problematic during COVID. So revisions have been larger. I think it's just important to remember that the employment data are already a lagging indicator of the business cycle. I think we get another strong data, I think we get another strong employment report. It just takes Fed rate hikes quarters to impact the economy. And we often don't see the unemployment rate keeps climbing well after the Fed has stopped raising rates, long after it stopped trying to slow the economy down. So I think we get another strong payroll report. My canary in the coal mine is always initial claims, which have stayed very low. If that starts backing up, we get a 5%, 10% increase in claims. To me, that would be a really hard sign that company behavior around employees has changed radically. But, we have been resilient in this job market, wave after wave of COVID, depending on what's hitting us. Employers are holding on to their bodies.
Laura, I got to go back to first principles. Laura, China reopens. What does the dollar do?
I think the dollar continues to strengthen across the majors, Tom, but I think it can stay strong against the yuan. I think that the exchange rate is going to be one of the last things that the Chinese authorities do to try to right-size the fact that they need to continue to stimulate the economy. I actually think we could see more dollar strength against the Southeast Asian complex and against the renminbi.
Laura, thank you. Laura Rain there of FS Investments on an FX market that I think the next stop for this one, Lisa, away from payrolls and the US data, it's got to be the ECB next week. And President Lagarde, after speaking to Francine Lacqua last week in Davos, really teeing up this ECB to do something it has not done for a long, long time, and that's raise interest rates.
9 days away, I think that this ECB meeting is actually going to be one of the most pivotal in its history, especially in light of record inflation and in light of some of the disagreements that you're hearing from ECB officials, not about whether to raise rates, but by how much and whether a 50 basis point rate hike is on the table.
Have we established whether that is euro negative or euro positive?
No, absolutely not.
Still totally divided on that issue.
Unclear what that actually means at a time when it really has to do with the momentum in the economy just as much as rate positioning. And frankly, the ECB is going to remain behind what the Federal Reserve does. It's just about whether it raises rates to support the economy and create some sort of ceiling for inflation or whether it actually dampens growth in a material way that's going to be harmful.
And that's a complex one, Tom. With this economic backdrop for this ECB to raise interest rates, what does it mean for this currency? Positive or negative?
I don't have a clue because you've got to fold in the war. I think the war over the weekend, John, this has been underreported, was absolutely brutal. There were drone images somewhere out in the zeitgeist that looked like something out of World War I. I think the news flow is so extraordinary that Lagarde just has to get to the meeting.
Policymakers in a tough spot around the world, Tom, in about 3 minutes' time, let's call it 5 or 6. Brian Deese, the National Economic Council Director, joining us on this show just 5 minutes away, Tom. Big conversation still ahead.
He's going to talk to lots of the media today, but we need to ask him, John, pointed questions about the history of the Fed sitting in the Oval Office and what the president's going to do about Fed independence. We know for certain President Trump would approach this differently.
A difficult one in many ways, Lisa, and how many times have we said that so far this morning? The optics of this, what do you make of the optics of this meeting later this afternoon between the President, Chair Powell and Secretary Yellen?
How much is this going to be a blame game? I don't think this is going to be kumbaya. This is going to be President Biden saying to the Fed, get on this. This is your job. This is what you need to do to control this. How much does it actually put pressure on Fed Chair Jay Powell to go more aggressively or, frankly, to show his independence? Because right now there's a credibility issue on both sides, getting inflation under control as well as being independent from the political bodies.
Are you suggesting still the Fed pivot wasn't down to the ECI data and it was down to the chairman getting a second term?
I wasn't going there, but I'm sure that you'd like to go there.
I love to go there. I love to go there. Unfortunately,
know.
Chairman Powell won't sit down with me and have that conversation.
Wouldn't
that be nice, Tom? You don't agree with it? You think it was the ECI data point?
I think the Fed is going to do what the Fed does, and the president knows it. This is a president that has a very clear history of LBJ and McChesney Martin Bill Martin in the middle 1960s. But John, it's okay. Lisa and I didn't agree on Velveeta cheese fondue in Davos either.
I imagine I would take the other side of that one too,
Tom.
I'd be firmly on Team Bramo on that issue.
Just a log of Velveeta melting.
Sounds disgusting.
Gorgeous.
Brian Deese is going to be joining us, the National Economic Council Director from the White House, 5 minutes away from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. European Union leaders have agreed to back a partial ban on Russian oil. It would be part of a sixth package of sanctions aimed at punishing Russia for invading Ukraine. The sanctions would ban the purchase of Russian oil and petroleum products delivered by ships, but it temporarily allows EU nations to buy Russian oil delivered by pipeline. That exemption is needed to get Hungary to sign on. Inflation in the Eurozone accelerated to an all-time high this month. Consumer prices rose more than expected, 8.1% from a year ago. Food and energy were the big reasons. The data will intensify the debate at the European Central Bank about how fast to raise interest rates. And President Biden says there are limits to what he can do about guns. Over the weekend, the president visited the Texas elementary school where 19 children and 2 teachers were killed. He has renewed calls for Congress to crack down on the kinds of assault weapons that were used to carry out the killings. PIMCO will be one of the biggest players in this week's drama over whether Russia's credit default swaps will pay out. The firm's largest fund increased its exposure to Russian swaps to more than $1 billion in the run-up to the invasion of Ukraine. PIMCO is part of a panel of dealers and investors that meets today to decide whether the swaps should be triggered. GSK has agreed to buy vaccine maker Stavridis, for as much as $3.3 billion. The British pharmaceutical company is buying up next-generation vaccines while it prepares to split with its consumer health unit. Last month, GSK announced a takeover of Sierra Oncology, a maker of targeted therapies for rare forms of cancer. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I think the time has passed for a soft landing. We could have done it, but that would have implied the Fed moving 9 months ago. It should have, it didn't.
That was Mohammed Al-Arian there weighing in on the situation with the Federal Reserve. Chairman Powell a little bit later this afternoon, TK, with the President of the United States and Secretary Yellen as well. An important meeting taking place a little bit later today.
Something we haven't mentioned here, John, the real yield, the 10-year real yield comes down over the last week, 0.12%, showing some of the interesting dynamics within the markets. The dynamic of the morning will be the Oval Office with the chairman of the Federal Reserve System and his president, joined by the Secretary of Treasury, of course, the former chair of the Fed, Janet Yellen. Powell, Yellen, and Biden. Brian Deese joins, director of the National Economic Council, who will be in charge of niceties and pouring tea at the meeting. Brian, the singular distinction here is Yellen codified the word slack of an America unemployed. That is not the case now. Powell's Fed is roughly a fully employed America. How will the president listen to these two about jobs in America in this horrific inflation?
Well, he'll listen to them and he'll underscore his core point, which is that he intends to provide the Fed with the space and the independence that it needs to operate. As you all know, he has nominated a quality slate of people, including at the top of that slate, Chair Powell, to lead the Federal Reserve through this challenging time, and he intends to give them the space to operate. But we are in an environment, a unique environment, and we have unique economic strengths right now, the job market and the labor market being chief among them, but not the only one. Household balance sheets are in a very strong position because over the course of this recovery, Americans have been able to save more and pay down debt. We're seeing business creation, small business creation up at record levels. So we have unique economic strengths which position us well now to focus on this challenge, which is bringing prices down. Obviously, the Federal Reserve plays a primary role in that, but fiscal policy and the economic choices that we make with Congress play an important role as well. All of that will be on the table today.
Brian, let's talk about that meeting today and whether it's anything more than a photo op, given that you've said You don't want to comment on Fed policy. The Fed doesn't want to comment on fiscal policy. What is the purpose of today? If it's not just a photo op, what do you discuss? What comes out of it? How does it help Americans? And you've seen the polls yourself. 65% of adults say their family's income is falling behind the cost of living. So a lot of people looking at this, it feels just like a photo op. For Americans struggling right now, they want more than just that. Is it more than that?
Absolutely. A couple things. The first is it's standard practice for presidents and chairs of the Federal Reserve to meet from time to time to share views on the economy. In this case, secondly, the president is underscoring something important. The respect for the independence of the Fed as an institution is not something that we can take for granted. It's not something that prior presidents have done to re-underwrite that independence. And so doing so, having the president do so in a public way and underscore that he is committed to making sure that the Federal Reserve as an independent institution can operate is incredibly important at this moment. And it's not just about a photo op, it's about sending that signal clearly to the public. And number three, they have a president, the American people, those who are feeling anxious, and absolutely understand that when people go to the gas pump or to the grocery store, they are feeling anxious. They have a president who is waking up in the morning and focused on how to address that challenge. And one of the things he can do is, in his position, underscore the independence of the Federal Reserve. So I think for all of those reasons, this is an important step in the process, not the only step. And we are going to remain focused. And over the course of the next week and the week after that, we'll focus on the steps that we can take to help try to address price increases as well.
One thing under discussion, and we know this from several reports, and we've talked about this previously, Brian, is student debt relief. The White House considering something up to $10,000. There are people without a college degree wondering why those with a college degree are getting this help. I'll go through the numbers and then I'll ask for your response. So the latest research from Pew points out that 4 in 10 Americans aged 25 or older have a bachelor's degree or higher. Among that, as you know, for black American adults, for Hispanic adults, that number is much, much lower than 4 in 10. You also know there's a growing earnings gap between those who have a college degree and those who do not. The unemployment rate is lower for those that have a college degree compared to those who do not. So the question, Brian, that people are asking if they don't have a college degree right now is, who is that to help? Who are you doing that for? Why are you considering doing that? Who's it for, other than just energizing the base going into the midterms later this year?
Well, first, we should be trying to help everybody who wants to work get into a job that will give them pay and an upward mobility and opportunity to succeed. And one of the things we're seeing about having such a strong labor market recovery right now is we're seeing historic gains, not just overall, the largest decline in the unemployment rate in any recovery in recent history, but also record gains for blacks. Record reduction in the unemployment rate. Hispanics, the largest reduction in the unemployment rate for Hispanics ever on record. So we're seeing that in the job market. We want to do more. A lot of that is about workplace training,
well, Brian, excuse me to jump in. I just want to nail down the point because you know this is important. As you know, and I'll repeat it, those with a college degree seem to be doing much, much better than those without. As you work out relief for the American people at the moment, why is there focus on $10,000 of student debt relief at a time when those people in America who do not have a college degree are getting squeezed by gas prices? Crude again this morning at 118. JP Morgan saying gas could hit $6 later this year. You know the people that's hitting the most. Many of those do not have a college degree. Why is this administration focused on doing something which, let's face it, might play well in the midterms, but ultimately isn't going to help those people that need the help the most right now?
Yeah, my point is we're focused on trying to help everybody. But to the question of those, and a lot of the steps that we are taking are going to help people who have less than a college degree. But when you look at the issue of student debt, there are tens of millions of Americans out there who are in the labor market and now may have gotten some college education or a college education, but are held back by the burden of having to pay, in some cases, extraordinarily high debt. So the question there is are there steps that we can take, prudent steps that we can take to try to help unlock economic opportunities for those families, while at the same time doing everything we can to help create a labor market that is creating dynamics like the one we're seeing now, where for the first time in a very long time, people without a college degree, people with some college degree are seeing economic opportunities to move into jobs with higher wages that they haven't in some time. We're also focused on trying to sustain that and continue that going forward.
Brian, good to catch up. As always fantastic to get your perspective on things. Brian Deese there of the National Economic Council. Tough moment for this White House. Lisa. For many people, they hope that it's more than just a photo op later this afternoon, because the polls for this president aren't promising for this administration.
It's a very difficult issue because there's so many different features that are playing into inflation, and there is such a bifurcated nature to the pain being felt by households that have college degrees and households that have higher incomes and those that do not. How do you sort of parse that out and speak to everyone when everyone's facing a very different reality?
Tom, why the focus on the $10,000? We tried to nail that down. Why the focus on student debt relief?
Oh, I don't. John, to me, it's a side story. To me, the major issue here is investment, spurring investment spending, and spurring trade, as the president did when he went to North Asia. I just think the investment lift is the only way out of this mess.
Futures down about 0.5% on the S&P, on the Nasdaq down by around about 0.1%. A little bit later this afternoon, the President of the United States sitting down with the Chairman of the Federal Reserve. From New York, this is Bloomberg.
The three major areas of the global economy are slowing at the same time.
What the market has told us over the last 3 months really is they think the Fed has got this.
You want to be in this market, but you want to be managing your risks. That's the key here.
It's not just the bond bear market you're talking about. You're talking about a stock bear market.
This is not a time when you try to chase and call a bottom, call a peak, call an inflection point, because honestly, inflection points are happening daily.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. We welcome all of you back to our studios in New York. And John, the singular story this morning is oil, American oil, 119 a barrel. We saw a 122 print on Brent.
Driving season begins, Tom, and it begins with gas prices approaching $5 on average across this country. Some places higher, some places lower. But TK, the direction is pretty clear. We mentioned some of the research from JP Morgan. It could hit $6 later this year. There's a problem, Tom, in the economy for a lot of those people experiencing that in a bigger way. And there's a problem in this White House, too, on how to address it.
This week on economic data gets us to the mid-year outlook. You wonder what the mid-year outlook is, John, for the President of the United States as he sits down with the Secretary of Treasury and the Chairman of the Federal Reserve.
And approaching, Tom, a mid-year outlook for this Federal Reserve as well. Last week it was President Bostic teeing up a pause maybe later this summer. Yesterday afternoon it was Governor Wallace saying, no, thank you. We've got a lot of work to do.
Well, we've got a lot of work to do. John, I'm going to go back to the idea of the many uncertainties that are out there. And downplayed here over the weekend was a China reopening, just the headline that flew by 20 minutes ago of Beijing schools opening in June.
And push that through the commodity market. The trend is clear, Tom.
Yeah.
You were waiting for it. Crude higher, Brent, WTI back through 120 on Brent. Tom, I give the policymakers a lot of grief, but let's face it, if you're a policymaker, if you're a member of a C-suite, a corporation in the leadership, an investor right now, gauging where this economy is and where it's going is tremendously difficult to do because it's moving so quickly.
Lisa, the 8% inflation statistics in Europe today, Italy, Japan, Germany rather, and the rest comes down to the inflation meeting this afternoon, 1 p.m. With the president. What are they going to talk about?
Honestly, and what does it matter? I mean, we were talking about that with Brian Deese, right? I mean, we were asking, what's the point of this meeting if you're trying to reaffirm the independence of the Fed? What are they going for here other than a photo op? Honestly, how do you address it when you keep getting buffeted by new events? And I think about the China reopening that you talk about, Tom.
Well,
how much does this have legs, right? I mean, if they continue to soften a zero COVID stance, how much do we see that sort of upward trajectory go well beyond what people are expecting with oil and gas?
Our guests to a person say the only way to address it, Lisa, is to raise rates. We assume that in June, right?
Look, how is that going to solve the oil and gas problems, right? That's not going to solve the oil and gas problems. Maybe it'll reduce demand, but you're not really seeing that. There still has been an increase year over year in spending, even on an inflation-adjusted basis, even with real wages deeply negative. At what point do you start to see the slowdown in demand and some of the pushback from consumers to the higher prices?
John, I hereby dub June, and I'm going to go back to FDR in the heart of the Depression. As I paraphrase, FDR said, do something. It's do something June.
June 15th, the Fed will do something. Most likely hike rates 50 basis points. They'll go again in late July, Tom. Most likely 50 basis points. And then there's a big gap between then into September with Jackson Hole in between. And that's why there's space, a little bit of vacuum if you will, Tom, that people are filling with this idea that that's when you get a pause from this Fed into September and beyond?
Brent crude 123.69, West Texas 118.70. What else do you see, John?
Equities down just a little bit, softer by 0.6%. I have to say, if you asked me to guess yesterday after seeing those words from Governor Waller, I'd expect us to be down a whole lot more. We're not. Futures on the Nasdaq down about 0.2%. You are seeing that move in yields, though, up by 8 basis points on a 10-year to 282. Not all of that is Governor Waller, the Fed, and US. It's all about Europe too. Upside surprise, Tom, after upside surprise on inflation reads in Europe. Euro dollar 107.07, negative 0.7 on that currency pair.
Critically, the real yield coming down. It's still positive 0.12%. Something to watch during the week. And someone always watching that is Peter Cherry. He's head of macro strategy at Academy Securities, traveling this nation for Academy Securities, and someone who does a beautiful synthesis across equities, bonds, currencies, and commodities. Peter, what's it like out there? You've been on the plane, you've been in the hotels. I know you stay exclusively at fancy places like the St. Regis, the Four Seasons, and the rest. What are you hearing out there?
Well, none of that's in our budget. But anyways, I think there's this frustration with where policy is headed. I think, as Lisa said earlier, are we addressing the right thing, right? I think we're supposed to be figuring out how to increase our own ability to supply ourselves, right? How do we turn on, refineries in this country? How do we figure out a solution to this problem that is both holistic and longer lasting, right? So everything seems a little bit haphazard, very reactionary, and we've got to get back to the table and sit there and almost make a war plan. How do we want to address energy problems? How do we want to address food problems? And I think we have to go back to rewarding companies for developing supply chains. And that's got to be the message we should be getting. It's unfortunately not the message we are getting.
Well, Pete, for a long time you talked about bringing those supply chains home. You were talking about that years ago. Pete, is that a theme that you can invest in still?
Yes, I think so. And I think, in fact, we've been talking a lot about bringing it back to South America, even Mexico. And as we go through these conversations, I think companies are taking a much closer look at proximity when they think about their supply chains. Not only are they looking at cheapness, but they're looking at risk of disruption, cost potentials. And I think everything kind of points you to having those supply chains closer to home. So I think you're going to see, some redundancies built in. I think you're going to see Mexico be a big beneficiary. And that is going on. And I think that's going to be a 3 to 5 year project. I think it's going to be inflationary. It's going to be steadily inflationary. And raising rates does not help that, right? Because it just causes companies to have to spend more to build out those plans.
That's exactly where I was going to go, Peter. A lot of these things are deeply inflationary, whether it's dealing with environmental issues, whether it's dealing with, frankly, just the higher costs of employment and being more safe and aware of what's going on. How much is that baked into the inflation assumptions going forward? Where do we end up for the next 3 to 5 years, despite the 2% target of the Fed?
I think we're going to be in that 3 to 4% consistent inflation level. And I think it's going to be for 3 to 5 years because of all this reshoring, this, rechanging of supply chains, this extra focus on, quote unquote, security. But you want redundancies. You're going to have larger inventories so that you're not subject to, supply chains being shut off. So all that's going to be steadily inflationary. I think the key is, though, so long as we are generating good jobs, those people who are getting the good jobs can keep up with inflation. So that's the important, I think that's where we need to be focusing on, is making sure that these jobs pay well enough, which they should, and then maybe figuring out how to support that, the people who are unfortunately being left behind. But I'm actually somewhat comfortable that the growth that I'm projecting, the way I see it playing out, it's going to create good, safe jobs that let people in this country do well.
So 3 to 4% inflation for 3 to 5 years. What does that mean for a 10-year yield that still is flirting with negative real yield territory at a time when we got the Fed starting Wednesday engaged with quantitative tightening?
I think we're going to have trouble getting much above 3%, although, in theory, we should be with that sort of level of inflation. But I think everyone's going to be aware that the Fed is going to kind of go through these series of where maybe they're behind the curve, maybe they've already done too much. And ultimately, as much as inflation's a problem, job growth is going to be a bigger problem. And you started hearing some of those earning calls last week and the week before where people are talking about maybe they have too many employees. So I think the Fed has to be very, very careful, because no matter how bad inflation sounds, job losses are even worse. So I think the Fed's not going to be able to be as aggressive as people think. And that's going to keep the 10-year, I think, in this 2.50 to 3% range for the next few months.
Pete, just before we go, I'd like to spend some time on this. You started your note yesterday by saying on this Memorial Day, I'd like to honour all that made the ultimate sacrifice in defence of our country. As many people know, perhaps they don't, Academy makes up a big proportion of the veterans over at Academy, are veterans rather. Pete, talk to me about that, the insight that gives you on issues like Russia right now and China for that matter as well.
You know, I think it's been really critical. One is we have our geopolitical intelligence group, which is 14 retired generals and admirals and 1 retired astronaut. So I think we got a really different perspective on how these things play out. And when people talk about no-fly zones, we can understand what it means to enforce a no-fly zone, why we didn't do that. So I think that's been really important. And one thing we've been doing a lot in meetings is, although people still want to talk about Ukraine and Russia, we can't take the eye off the ball of China, because China is out there collecting commodities. They're almost sanction-proofing themselves. We're seeing a shift in behavior with China, and that is really going to be the long-term what drives our economic future, is what China does, not so much what goes on in Russia and Ukraine.
Pete, one more on that. Sanction-proofing themselves. What are you seeing them do, and what are you looking to do off the back of it?
You know, I think this kind of ties into our theme of wanting to work with people that are close to us, because that's what China is doing, right? They are effectively lining up the autocratic nations of the world who tend to be commodity rich to sell China those commodities. China wants the commodities. They claim they'll be a good customer because they are going to be burning oil, coal, you know, natural gas for decades to come. So that's where they're aligning. So I think we have to combat that by thinking, who do we want to partner with? Who do we want to work with? And that's changing that. To me, we're going to have this very much a Western Hemisphere alignment that we compete with.
Pete, awesome to catch up, as always. Peter Chair there of Academy Securities. On the elephant in the room in many places right now, Lisa, that's China.
It's all China, frankly. And honestly, people talk about Ukraine, but the issue of China, the issue of the lockdowns, what that does to the economy, the issue of Taiwan and a potential altercation there, the issue of what do you do if you have business in a nation that is so not transparent with respect to their health policies, as well as what kind of scrutiny they're going to have over you, is really the issue that a lot of people are dealing with.
That's the China situation. Tom, just going through the calendar through the summer. June 10th, CPI. July 13th, CPI. August 10th, CPI, all ahead of a big September meeting for this Federal Reserve.
Yeah, I'm going to get out to September, John. I think the 2 recent meetings are where they are, but to me it's September 21 and on to, I believe it's December 4th as well. These are key meetings, and again, they're massively data dependent, and in fact, the president will hear that today.
And ahead of that meeting at the back end of September, they'll get another read on September 13th on CPI. A lot of inflation prints for them to have a look back on and start to decide whether it still requires a 50 basis point frequency, an interest rate hike, something slower, or maybe a pause. Futures negative 0.7% on the S&P from a steamy New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word, I'm Ritika Gupta. President Biden will hold a rare Oval Office meeting today with Federal Reserve Chair Jerome Powell. Treasury Secretary Janet Yellen will join them to discuss what the administration calls the president's top economic priority, inflation. Rising prices are hurting the president, with voters just months before midterm elections. European Union leaders have paved the way for a sixth package of sanctions to punish Russia and President Vladimir Putin. They agreed to pursue a partial ban on Russian oil. It would forbid the purchase of crude oil and petroleum products from Russia delivered by sea, but there would be a temporary exemption for pipeline crude. That would satisfy Hungary, which gets Russian oil via pipeline. For the first time since early March, the number of daily coronavirus cases in China has dropped below 100. Still, Omicron's contagiousness means the reprieve from infections and the tough COVID-0 response may only be temporary. Both Beijing and Shanghai have started to loosen restrictions on mobility. More legal headaches for Deutsche Bank. Police in Frankfurt raided Germany's largest lender and its asset management unit, DWS. The search is related to accusations of so-called greenwashing by the asset manager. There have been claims that DWS was marketing investment products as being greener than they actually were. And shares of Unilever jumped today. Activist investor Nelson Peltz has been appointed as a director, and his Trian Fund Management has taken a 1.5% stake in the company. The appointment comes after a difficult period for Unilever. CEO Alan Hope failed in an attempt to take over the consumer division of GlaxoSmithKline and has had to grapple with steep inflation. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Oil, there is still spare capacity, but that spare capacity is quickly running dry. It's mainly in Saudi, mainly in OPEC. Now, it's a good question, and oil prices should be higher if you think about the marginal cost to produce the oil.
And they are higher this morning. That was Christian Malek, the global energy strategist at JP Morgan Securities. Futures are lower by 0.6% on the S&P. Crude is rallying, though. Crude right now, Tom, crude higher by 3%, 118.62 on WTI.
Right now, on the shock of where oil is, and again, the 123.59 on Brent crude is nicely above the March moving average, however you want to mention it, truly out to new sustained highs. A good time to speak to Ellen Wald. Her book, Saudi Inc., is just absolutely extraordinary, senior fellow at the Atlantic Council. Ellen, whether it's Christian Malek and his team at JP Morgan or Peter Shearer, who we just talked to, everyone is screaming about investment in oil, and it can be at any part of the oil process. Do the Saudis want to lead OPEC Plus to a greater investment in oil?
I would say absolutely, and this is something that Amin Nasser, who's the CEO of Aramco, has actually been talking about for years now, although much more loudly, particularly since the Aramco IPO, is that investment in oil and in all parts of the oil chain has been so low for so long that even without this Russian crisis, you could say, right, oil prices would be higher simply because of this lack of investment, and we're not necessarily seeing a big enough response in terms of investment, except from the countries that have continued to invest in oil, like the UAE and Saudi Arabia.
How do we jumpstart the investment in hydrocarbons?
It's, I think it starts with an acknowledgement that we still need oil. We may not want to need oil. We may wish we didn't need oil. But if we want to continue with the way that we live, with our modern lifestyle, with driving cars and using airplanes and shipping things across the world, we need hydrocarbons. And yes, there are cleaner ways to produce hydrocarbons, and there are not so clean ways to produce them, but we still need them. And that needs to be acknowledged at every level, especially by governments, because when government support isn't there, investors and investment bodies take their cues from there, and they don't want to invest in something that they think the government is going to put extra taxes on or make impossible to use in just a few years.
Well, and Ellen, there's also a reluctance by investors to put their money into companies that are viewed as bad or viewed as contributing to global warming. Have we seen capitulation on that front as we see strategist after strategist say commodities are their favorite place to be?
Exactly, and I think that we're definitely seeing some people and some investors say, so what? It doesn't matter. I don't care about the backlash. I don't care about public opinion. I'm going to put my money in this area that I think is going to make money, because at the end of the day, that's really what they're looking for, is a return on investment. Yes, they want to do good for the world, but that's really secondary to making money. And but you're still going to have some people and some investment places that are more concerned about public opinion, or they believe that public opinion is so strong that governments will continue to make these investments too difficult, and that will cut into the return on investment. And until we see a real, and in particular, especially in the United States, we need consistency in regulation. We need to know what's going to happen 5, 10, 15, 20 years down the line, not just, everything could be changed with a new administration in 4 years.
Ellen, I'm going to ask you the same thing that we talked about with Christian Malek last week, which is, why aren't oil prices even higher given some of the shortfalls in production?
Yeah, exactly. I mean, we're seeing higher oil prices. I think that the market is still pretty volatile, and we're also concerned a bit about demand destruction at this point. We're seeing some pullback in consumption in the United States. There's definitely concern about China. Yes, we're hearing news that some of these lockdowns are being eased, and that's definitely going to impact demand, cause demand to go up. But as inflation gets higher and higher, it's really going to cut into people's use of hydrocarbons, of fuel, especially because these are things that are so high priced now.
Ellen Wald, within this conversation, sort of the out-of-body experience for me is it whether it's Exxon or Aramco or, an independent driller in Oklahoma or Texas, they're not waiting for the government to help them with investment. why aren't they investing at $130 a barrel?
That's a really, really great question, and there are actually a bunch of reasons. Some of them are actually really well articulated by the survey that the Dallas Fed does of oil producers in the U.S. A lot of it has to do with cost. The costs of drilling now have gone up in a huge way. They're not able to get a lot of the materials that they need, so there are delays in terms of supply chain issues, and also they have been pressured so much to give this return on investment to their investors that they're really hesitant to take those profits and put them back into drilling, especially when costs are so high. They also can't get labor. There are labor shortages. Even if they pay more money, they still can't get people to come and work. So there are a lot of issues here. I think that some of these will work themselves out, but it's going to take months.
Ellen, thank you, as always. The brilliant Ellen Wald there of the Atlantic Council. Ramping up production is not that simple. The good news is that production in America is actually climbing and has been doing so for the last couple of months, Tom. I believe we're back to about 11 million barrels a day. Still off those numbers of, say, 13 from before the pandemic. We've got refining issues. It's difficult to ramp up capacity. We know we've got a capacity issue with refining. The energy players doing okay. They're doing better than okay. Last week on the S&P, those names were up by more than 8%. And year-to-date so far, and I have to admit I hadn't checked in on this for a couple of weeks, up 58.26%, Tom, year-to-date. That's the energy players on the S&P 500.
I'm not going to do buy, hold, sell on oil, John. That's not our job here. But I will say that when you look at a lot of the literature, whether it's from Royal Dutch Shell or the J.P. Morgan work we've cited, coal is sort of flat on its back. And other than that, you need a lot of investment across a lot of different makers of energy, whether it's solar or biomass or certainly hydrocarbons and gas.
You cited the work of J.P. Morgan. Bramo, capacity is a word that comes up again and again and again when you speak to Christian Malik.
Yeah, and it has to do with investments. It has to do with just how much you have to pay everybody, how much the actual materials have increased to also expend. But also, frankly, shareholders don't want those investments, right? I mean, shale producers in the U.S. have been penalized for overbuilding during good times, only to get busted during the bad.
And these are some better times for some of those names, that's for sure. Going by the stock price reaction anyway. Futures are down about 28, let's call it 29 and round down. We're down by 0.7% on the S&P. From New York, heard on radio, seen on TV, this is Bloomberg. We are coming off the back of a big weekly gain, a monster weekly gain on the S&P 500 of just short of 6.6%. We trimmed some of that this morning. Good morning to you. Live on TV and radio, this is Bloomberg Surveillance with futures negative about 0.6% on the S&P, on the Nasdaq down by 0.4%, and yields breaking out just a little bit more in the last 15 minutes, up by, let's call it 13 basis points, Tom, now on a 10-year, 286.58.
John, I'm glad you mentioned that. We were 7 basis points and now out 12, 13 basis points. And it's so much of a yield lower move last week while you were in Capri that we're really back to center tendency.
Bostic versus Waller, Tom. It's as simple as that. Yeah. President Bostic last week suggesting we could pause rate hikes. Governor Waller yesterday saying anything but. He's looking for more moves to get inflation back down towards 2%. Yeah. After we had Bostic, maybe the data started to validate that idea. Perhaps you had that idea going into the minutes and the minutes confirmed what you already thought. Tom, coming out of it, listening to the Fed governor, there's no consensus on that pause anytime soon.
3.1% move in West Texas Intermediate. Right now, and hugely anticipated, Leland Miller is co-founder, the chief executive officer of China Beige Book. But far more, he is someone with his pulse on the Chinese data. The dynamics is taken from the microdata of China. He joins us this morning. I want to talk, Leland, about the Shanghai calculus, about the rate of change, the second derivative, the rate of change of the rate of change that the government in Beijing needs from Shanghai. How desperate is Beijing for Shanghai to get it going?
Well, they're very desperate, first of all, because Shanghai is a growth engine, but second, because it's a confidence engine for the economy. And what's so curious about, the PMI data that came out last night, a few days after an extraordinarily panicky meeting, something we haven't seen in decades. All of a sudden, the data come out last night, and they're improving from May. April was bad, but May's getting better. That's the opposite of what we saw in China beige book data. We actually saw much more problems in May as the secondary consequences of the lockdown spread away from Shanghai. So, they want to tell a pretty story right now. It's important for markets, but, we did not see an improvement from April to May. We saw the opposite.
So, Leland, give us a sense of what the China beige book is charting out to the end of the year in terms of GDP, the real GDP of China, not necessarily the 4.5–5% that the Communist Party would like to say.
Well, look, if you assume the second quarter is in contraction, no matter what they do, or give or take a little bit, then, the question is, what are they going to do the second half of the year without rolling back COVID lockdowns or COVID zero lockdowns, if they need them, to get the GDP somewhere in a range that they can claim. I think that the new calculus is we're going to get to the fourth quarter. We're going to hope there's no COVID, and we're going to announce, 5% GDP for the fourth quarter and try to get it somewhere between, 3 and 4% claiming 3 and 4% for the year, then I think markets will say, okay, that's not too bad. We are not on track for anywhere near that. You have to have a lot more support for the economy and a lot less COVID lockdowns for the economy in order for us to get anywhere near that ballpark amount. But I think that's the story they want to tell.
What are we on the ballpark for? What are we on track for based on the China beige book data?
Well, I mean, with the second quarter as weak as it is, and if you try to do any type of linear projection, you're under 2. You have to see a lot more support for the economy, which I do think we'll do. As we get close to the Party Congress, we do expect there to be more credit support. We do expect there to be a little more infrastructure. That's not surprising, but you're going to have to see a lot more of that, and it can't be interrupted by lockdowns across the economy.
Leland Miller, dang. Years ago, to get rich is glorious. How far are we removed from that in this Chinese crisis?
I don't think we're that far away from it. If anything, some of what we've been taught over the past 6 months is that the Chinese model is not actually any more superior than any other model. They just had COVID at a different time, and now they're getting hit pretty hard with it. So everything has to get through the Party Congress. She has to have his political moment, and then they can start recalibrating the economy and the stock market and the regulatory system.
Do we underestimate the unchanged China that Deng said to get rich is glorious, and that's what they want to do? And do we overestimate right now the Xi totalitarian shift?
I think we did until a few weeks ago, but I think what seeing all this, headline conflict between Xi Jinping and the ostensible number 2, Li Keqiang, I think people are understanding how much opposition there is within China in the leadership amongst people who are being locked down to this COVID zero lockdown policy and to this slowing economy. And so we are now seeing the dirty side of China's governance right now. And I think people are more aware of it.
Leland, a lot of people have been looking out and wondering what we're going to see with respect to U.S. businesses, multinational businesses, and supply chains, why we haven't seen more of some sort of removal from certain facilities in China elsewhere. Are we now starting to see that after years of speculation?
I think so. And for one reason, the trade war didn't do it. COVID didn't do it. But the lockdowns are something else. And I think you're going to have a very hard time, not just getting Western businesses run across China, but getting expats or anyone to work at these businesses. Nobody wants to be in China right now. No one wants to be locked down and they can't see their families who may be elsewhere for a year, for 6 months, for longer than that. So I think this has shifted the calculus for people who want to live in China. It's made it much more difficult, and they're going to have a much harder time running businesses in China because of it.
U.S. executives are not going to come out and say that they're getting out of China, right? Because they're not going to say that until they already have. They don't want to hamper their employees who work there. They also don't want to get some blowback from the Chinese government. How much have you seen this withdrawal? I mean, this is basically the big question for a lot of companies that have been pretty quiet on this.
Well, I think it's telltale that just about everybody I know is either out on their way out or has already left. And there's very few people with plans to go into China anytime soon. I mean, it's just very difficult to travel, and it's very difficult to operate and live. So people don't want to accept that.
Link that change to the Party Congress then later this autumn.
Well, I think what the party Congress does is she has his moment, and then after that, they can recalibrate certain things. If they need to change COVID zero, they can change COVID zero. If they need to.
But Leland, I don't mean to interrupt, but can they even spare the time to get to December or January of next year?
I don't see how they do it. They have to be extraordinarily lucky, and they have to introduce vaccines. And even by the Chinese reckoning, that they say they're not going to be introducing them until October. So they're having some very, very difficult conversations now. This is far and away the worst conditions that we've seen in years, and there's no way out if COVID returns. So. You have to be crossing your fingers. If you're thinking China is going to really improve in the second half, you are crossing your fingers. Both the policy support will be there, and also that COVID won't just come and knock them off their feet again.
Leland, that's the story of this cycle and the economy. I wanted to finish on something really important. I think, as we've both observed over the last 10 years, it was clear and obvious to a lot of people the trajectory of some of the policy out of Russia and where this might end up. There are some people who have turned around in the last few months and have acted surprised that this has actually happened. Many others aren't surprised at all. Do you foresee the same thing happening further down the road with China? There are allegations of human rights abuses, genocide. Those allegations have come from a range of countries. The US, UK, Canada, and the Netherlands have all accused this country of committing genocide. There was a latest bunch of files last week obtained by a series of media groups, reporters, journalists, Leland, speaking to some of the detail around those human rights abuses. And yet, Leland, it's largely absent from the conversation of corporations engaging with the Chinese Communist Party and the economy there. It kind of sets us up for me, Leland, in a similar story to Russia. They ignore it, they ignore it, they ignore it, and then we get further down the line and they can't ignore it anymore. Where do you see this going?
Well, they're ignoring it in public conversations, but they're talking about it in private. And I think what most of these companies are up to right now is trying to understand whether they're going to have to completely separate their China business, their domestic China business, from their business from the rest of the world. And I think that the more that there is a political imperative to have one set of views on the Western side and find certain things unacceptable, and another view that reflects the Chinese Communist Party's views in the mainland, a lot of these corporations, they may not pull out of China, but what they may do is separate their China business from the rest of the world business. And we're talking about separated supply chains, separated corporate entities. This is a big, big change. Folks don't want to be talking about it, but they're absolutely planning for it right now.
Leland, where would that leave a company like, say, Apple? Where would it leave them?
Well, Apple, I would have to produce what it produces for Chinese consumers inside the country, and then it's going to have to find a lot of extra production capacity in Southeast Asia, in Mexico, and other places to produce all these, iPhones and iMacs and other things for the rest of the world. So what they're not going to be able to do is rely on Chinese production capacity for most of their production going forward. And they're absolutely trying to work out contingency plans, but it's harder for Apple than just about any other country in the world. So they've got enormous headwinds specifically in the next couple of years.
Leland, really interested to get your thoughts on those questions. Thank you, sir. Leland Miller there of the China Beige Book International. Bramo, an important topic that is being discussed, and according to Leland Miller, being discussed a whole lot more behind closed doors.
Yeah, and actions actually being taken. CEOs do not want to come out and say anything with respect to withdrawal from China because they will get blowback. But what they are doing on the ground, according to Leland Miller, is very different. And that has incredible implications, not only for China's GDP, but frankly for inflation at a time when that's going to be inflationary to rebuild supply chains elsewhere.
Futures right now down about 0.75%. There has been a change in the bond market in the last 20 minutes. Not a change of direction, but maybe in a magnitude of the move. Yields are higher by 13 basis points on a 10-year to 286.58. Just a few words from Governor Waller. That's all it took yesterday, Tom, to suggest that he sees a lot more rate hikes in the future to get inflation back down towards 2%.
Now, some legit dollar strength as well. The euro was a 107, now 106.86, and that bears watching. And it's confirmed by Euro Swissy coming in. You really wonder some of the tensions there beneath the headlines.
Looking forward to catching up with Savita Subramaniam of Bank of America a little bit later this morning. We'll catch up with her in about 20 minutes on Bloomberg TV. Alongside her, Peter Cecchini of Exonic and Michael Purvis of Toolback, and on the situation in this equity market and which side to be on right now, with President Bostic or with Governor Waller. The Bank of America view just around the corner from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. European Union leaders have agreed to back a partial ban on Russian oil. It would be part of a sixth package of sanctions aimed at punishing Russia for invading Ukraine. The sanctions would ban the purchase of Russian oil and petroleum products delivered by ships, but it temporarily allows EU nations to buy Russian oil delivered by pipeline. That exemption is needed to get Hungary to sign on. The CEO of Soros Fund Management says the U.S. is on track for a recession. Dawn Fitzpatrick was interviewed for Bloomberg Wealth with David Rubenstein.
There's a lot of discussion about a looming recession, and the bottom line is a recession is inevitable. It's a matter of when. And when you look at what markets are pricing here, they're pricing it fairly soon. So in the 2023 context, depending on which asset classes you're looking at, I actually think markets might be wrong. And the reason is the consumer right here is in extraordinarily good shape.
Watch David Rubenstein's exclusive interview with Soros Fund Management CEO and CIO Dawn Fitzpatrick tonight, 9 p.m. New York time on Bloomberg Wealth with David Rubenstein. The town of Uvalde, Texas, has begun saying goodbye to the 19 children and 2 teachers killed in last week's elementary school massacre. Visitations at the town's funeral homes were held yesterday for 2 10-year-old girls. This week alone, 12 funerals are planned. Meanwhile, lawmakers have said they'll consider what can be done to stem gun violence. It's Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We have unique economic strengths right now, the job market and the labor market being chief among them, but not the only one. Household balance sheets are in a very strong position. We're seeing business creation, small business creation up at record levels. So we have unique economic strengths, which position us well now to focus on this challenge, which is bringing prices down.
A spirited conversation with the National Economic Council Director, Brian Deese, who I believe will be serving tea today. For the President, the Secretary of Treasury, and the Chairman of the Federal Reserve System. Look for that coverage on Bloomberg at 1 o'clock on radio and television. Lisa Abramowicz and Tom Keene. John Ferro in treatment for his next property right now.
In treatment.
And joining us right now with the clearest note of the morning is Tom Satoris, head of fixed income research at Strategas. It is a Baird company. I love the clarity of your note that Biden, Powell, and Yellen have easy lifting down to a 5% inflation rate, but then. Is that really going to be the topic today on the couches in the Oval Office?
I think so. And the Biden administration has a very real problem here. They've got to get inflation down to a more comfortable 3%. But the problem with that is getting it down to 5% is pretty easy. It's just seasonality, it's base effects.
Right.
Tightening will get us down to about a 4%, but getting down to a 3% probably is going to engineer a recession, and that's the real difficulty that both the Fed and the Biden administration have.
Are the PhDs at the Eccles Building looking at reaction functions and virtually differential calculus of the how to go from 5% to 3% inflation?
I think they are, but the question is, do they over-tighten along the way? If you look at the past history, the PhDs have said, keep going, and eventually something broke before they actually got to their model-driven end game. And there's a very high chance that happens again this time as well. They over-tighten and a recession ensues.
Tom, what kind of recession would it be?
Well, at this point in time, probably a fairly shallow recession because as has been mentioned, I believe Brian Deese had mentioned it earlier in the show, you're looking at a very good cushion right now for the consumer base. Home prices, cash out refis, and very strong wage inflation. So a recession should be shallow at this point unless the Fed really makes a mistake or there's another shock that we're unaware of.
Tom, do you buy this feeling that we heard last week that Raphael Bostic's train of thought was the right one, that there'd be some sort of pause in September or possibly after that when the Fed reassessed and decided to pull back from some of the tightening? Or do you think that the market is underestimating right now the resolve at the Federal Reserve?
Yeah, I think a pause is inevitable, whether it happens in September or later on this year. A pause could very well mean a slowdown to a 25 basis points per meeting rate hike path and really no change to the expected terminal Fed funds rate. and balance sheet reduction continues to proceed. I really don't think we're going to see a pause in the sense that the Fed basically stops tightening.
To fold in your work with Jason Trenick's work at Stavridis, does the market do the heavy lifting for the Fed? Does the market get out front on this and create a tightening atmosphere?
Well, the market does, but we estimate the market so far has done the equivalent of about 160 basis points of tightening. So if a neutral Fed funds rate is 3%, and inflation is basically running at a sticky state of 4%, there's a more tightening to come from the market. So the market has more tightening to go.
Okay, if a neutral Fed funds rate is 3%, what does that mean for a 10-year?
That means if we're still looking at a 4% sticky inflation, that means a 10-year has to be at or above 3%, but perhaps not by much. We'll say somewhere between a 3.25 to 3.35 is where you'd expect the 10-year to kind of deposit as a terminal rate, and it very well may come down below that fairly quickly once again.
So basically, has the Fed already been priced in? I mean, that's been basically the theme, that the first half of this year has really been about pricing in the rate moves, and the second half of the year will be pricing in the recession that you think is almost inevitable. Is that how you see it?
Yeah, I do think so. The Fed tightening path or rate hike path has been priced in, and that is a market pricing now somewhere around a 3 to 3.25 Fed funds rate. What's probably not priced in is, one, a full recession risk, as evident by an S&P 500 about 4,100. But also with 10-year yields, even at about a 286 as of this morning, you're still talking about 10-year yields below what the market expects the terminal effective Fed funds rate to be. So the market really isn't pricing in balance sheet reduction risk. And the same is true for mortgage spreads. You just don't see the spreads at levels that would indicate stress there.
Let's go back to your wheelhouse, which is Fannie Mae, and as you just mentioned, mortgage.
Yep.
You're not mere mortal on this. You're actually a god of studying Fannie Mae and housing data. How askew is our housing boom, or is it normal what we've seen?
Well, I think it's normal in the sense that you have a backlog, a queue of housing demand from the last decade that was probably pushed forward by bad policy coming out of 2010. And you also have had an underinvestment in housing. So now we're kind of playing some catch up. You add to that the fact that nominal growth has been pretty high, as well as very low mortgage rates. Even mortgage rates today, 5.25%. It's below nominal growth. So housing demand is strong. It's consistent with where you'd expect it to be. The question is, can home price appreciation continue at this pace? And the answer is almost certainly no.
So the second home that Lisa bought up by Tupper Lake with 800 acres overlooking some portage, and I think it's called Blackfly Camp.
Literally, you have scars from that,
She's
don't
not
you?
going to break even for 15 years? Is that what you're saying?
Well, I'm not going to make an individual base case call, but if I were buying at these prices right now, I'd be looking at demand softening over the next 12 to 24 months and potentially some seasonal weak spots where housing actually turns lower over the next 2 years.
What do you think, Lisa?
I think that you have some real memories about portaging and black flies. That's what I think. Tom Soros, thank you so much.
It's the time of year, Tom.
Yes.
Tom, it's black fly season, right, Lisa?
It is. Are we going to keep going with black flies? I am very much looking forward to black flies in our annual family vacation up in the Adirondacks. We'll be enjoying it. It'll be fantastic. Lots of portaging for the kids, Tom.
Not one single chemical has ever worked in the skin against a black fly.
You're not wrong about that.
Thank you so much, Mr. Stavridis here. But, Lisa, I bring it up because it's his wheelhouse. It's what he's acclaimed for when, Jason brought him on at Stavridis years ago. I'm not hearing enough about the housing outcome in America. I
think it's a good point that you're making right now, that perhaps we're not going to see a blowout of the entire pricing model like we did in 2008 and 2009, but we might see a lost decades of profits.
Yeah.
Particularly in certain areas. I don't know the answer to this. It's going to be really curious, especially at 9 a.m. when we get some data.
Lisa, oil, Brent crude popping 124 print moments ago. That's a wow statistic.
That's a wow statistic at a time when a lot of people say there's more to go.
Did we miss Ferro? I think we did. I thought, we got through it.
We got through it. We missed him.
We're not on speaking terms, but it worked. Good morning.